happy to have 5 distinguished speakers that will give us illuminating thoughts about the interplay between the climate change and the finance. So let me start with some small announcements about some changes. First of all, John Chukalas was supposed to chair, but due to a last-minute engagement, I'm replacing him as the chair of the session. The second change has been Changhua Wu will be speaking as the last panelist, and Mr. Kairat Kelimbetov will not be able to join us. Instead, we will have Mr. Balmi Bekmitov from Astana International Finance Center. So let me start by introducing the panelists and also reminding some house rules. Our first speaker will be Mr. Balmi Bekmitov, who is the chief economist of Astana International Finance Center. And Mr. Bekmitov has significant experience, having taken managing positions at the Financial Stability Department and Research Department of National Bank of Kazakhstan. And also he contributed to the design of Kazakhstan's Sovereign Wealth Fund. Our second speaker will be Ms. Charlotta Groth, who is the Managing Director of Zurich Insurance Group. Charlotta has also in the past worked as the Senior Economist and Research Manager at the Bank of England, and we'll be looking forward to hearing Charlotta's thoughts about the interplay between finance and the climate change. Our third speaker will be Mr. Christian Déséglise, who is the head of sustainable finance and investments at the global banking and markets at HSBC. He is also a member of One Planet Lab, a high-level advisory group set up by President Macron to address changes related to climate change. Also, Christian is the co-chair of World Economic Forum's Global Future Council on Sustainable Investments. And our next speaker will be Mr. Ding Yifan, who is the Associate Dean at Hainan Green Finance Research Institute. Mr. Ding Yifan is also Vice President of Chinese Society for World Economics and Director of Chinese Economic and Social Council. Finally, we will have the pleasure of hearing thoughts of Ms. Changhua Wu, who is the Asia-China Director of Office of Jeremy Rifkin and advisor to governments and corporations on sustainability issues. Ms. Wu has in the past great experience in leading policy discussions and policy agendas, especially on China's sustainability policy, and we'll be so happy to hear what Ms. Wu will be talking about Chinese perspective. So the floor is yours, Par, for your presentation. Thank you.
Thank you, Sner. Thank you very much. It's a pleasure and honor to speak here. And first of all, I would like to apologize for the Governor Kelimbetov. He was really looking forward to join this panel, but then it was a very high-level intergovernmental meeting. But I'm speaking his stead. I'm representing more policy-making side of the table, because we have different actors. We have businesses, we have academia, we have market participants, and of course, the policy-making side. And I just wanted to share our view, what we're thinking as a policymaker representing in government, what's government thinking, and what policy setting institutions like the Astana International Finance Center are working on achieving the climate change, climate finance, and achieving climate justice. I think what we're all trying to do is just to have this climate justice, intra-generational climate justice that needs to be achieved. So first of all, I think right now we understand that the transition to net zero economy affects all aspects of the global economy. Here in Glasgow, COP26, I just came this morning to Kazakhstan, and then we've seen all this interesting high-level discussions on Monday and Tuesday, and also following like the Wednesday, Thursday as well. We see that this COP26 is probably one of the most important conference of parties that we had in the recent years, because we have everyone understands this new agenda. Everyone understands this is not just another short-term trend. This is the reality, and it's not the question is not to follow the current trend. The question is now to accept this reality, accept that we have to change, we have to adapt, and we have to incorporate the current requirements, the current trends into our own development strategies. This concerns the governments, this concerns the companies. We've seen that over 120 countries, and I think about a fifth of world's largest companies have now net zero targets. If you look at Google searches, it has surged. If you look at the level of green finance, it has expanded very, very broadly. The whole financial system will now play a crucial role in achieving this global net zero emissions, because at the end, it's all about money. It's all about how we achieve it, where we have the instruments, what instruments we have at the hand. And I think this is important because it's not only the policy set, the top-down policy setting, because we as the governments commit to this, we have national determined contributions, but it's not only top-down, because we've seen that the new generation of, even millennials, the new generation of companies have this green agenda, environmental agenda on their mind, and the climate change has become also even a social movement as well. And we've seen, thanks to the efforts of thousands of people across the globe. We have Greta Thunberg, who set a great example for everyone just to fight for the climate change. I think we have that. We have, I think it's already is being embedded in the practices and the culture of new generation, and also generation of investors. This is why we see this growing demand. And it's not very null, because I think the climate change is very null. But then if you talk about ESG in general, it has been here for a few years. It's part of the Sustainable Development Goals of the United Nations. We've seen as a sustainable and responsible investment has become an agenda for many institutions. The Sovereign Wealth Fund, for example, Norway Pension Fund Global, which is one of the largest sovereign wealth funds, has been introducing this, embracing this agenda for a few years now. They have not been investing in pollution, in non-ESG compliant businesses for a few years now. But let me also share what's going on the policymaking side, because every country has different contributions. Every country has different commitment. And being from Kazakhstan, from an emerging market, I want to share the emerging market part of this, because we see that the developing markets and developed markets have slightly different agenda. It's more difficult, in my opinion, for the emerging markets to adapt that, because we still have great dependence on fossil fuel. But then that means for us it's a greater challenge, and also it fuels our ambition as an emerging country to also contribute to be on par with other countries. So in Kazakhstan, first of all, the Prime Minister, who was just speaking in Glasgow on Monday, has reconfirmed that we have the unconditional commitment to reduce our emissions by 15% from the base level. That's one. With additional support, if we talk about non-conditional additional support, the share could be increased even more. We are increasing our share of renewables from 3% to 15%. We're cutting our share of coal generated energy production from 70 to 40 in the next 30 years, and then the goal is by 2060 to become carbon neutral. For that, we also have the offsets. We have this, I think, very ambitious, very great program, in my opinion, very humanitarian program on planting 2 billion trees in Kazakhstan, because that will help the whole ecosystem in Kazakhstan. So this is on the exact policies. Obviously, as policymakers, we don't want to use only sticks, and not only sticks, we want to use more carrots rather than sticks. That's why we have developed green taxonomy to help companies to understand how they're doing the climate change related activities. We have developed environmental code. We want to introduce incentives. For example, we have the performance-linked bonds, performance-linked instruments. When we see that if company is overperforming in terms of environmental protection, then they'll have the lower rate on the coupon, and vice versa. If the company continues to pollute, then it will be more costly for them. So we wanted to make, the idea is just to make green finance more affordable for the companies as well, because they understand it's the sometimes the brown economies seem more competitive in terms of the short-term costs, but then if you're looking long-term, we all understand this is part of the the greater good, and it's also sustainable, and it's also even economically viable, because we are talking about long-term companies, long-term investments. And then, as I said, when we move to the financial system, when we move to the financial world, we also have regulators. We also have additional institutions who work on introducing new instruments. So, for example, last year in Kazakhstan, we had the first ever issuance of green bonds that was allowed with the participation of the Astana International Financial Center, and especially Green Finance Center. We have the specific center that works on the green finance introduction. It helps the government to develop new codes, new regulations. It's also playing an important part in the Kazakhstan long-term strategy of decarbonization, because we understand that should be part of our long-term strategy. And I think the one really important move that it's moving not from only Minister of Environment, because it was the responsibility, it's moving on the higher level. So moving on the level of the Prime Minister, and the Prime Minister was happy to announce that on Monday, that it's under the government, the whole government, it's a whole of government approach is working on that. And it's embracing this environmental agenda, embracing the climate change decarbonization agenda in every aspect of the work. And then we have the green transition. We have, as I said, the Green Finance Center. We have helped to issue green bonds with the green loans. There are already a handful of institutions, a handful of instruments that have been already introduced. We are working with the international and multinational companies and the financial institutions. We work with the Eurasian Bank for Development. It has become even a stakeholder in the Green Finance Center, and it's helping very actively with the programs that we have right now. It has allowed also Nur-Sultan, the city of Nur-Sultan, which is a kind of growing capital, to become recognized as in the global green finance index for the financial centers. It was ranked first in the region of Eastern Europe and Central Asia, just recently in October 2021, like last month. So I think this shows that our commitment as the government in general, and then as the financial center, Astana International Financial Center, which is setting the environment for financial companies and investments and the transactions, to introduce this agenda to make the green finance not only some goal that we need to strive, but also make it more viable, make it part of the general business, because we want to incentivize. And I think what's going on recently just shows that there's a great prospect for that. Companies understand that they need to be part of the global agenda, and we see great interest, and we see that the investments are flowing as well. So the business models have indeed changed, and that was one of the ideas that we discussed today. With the climate change, we understand, so if climate is changing, then the business model should change as well, if we want to keep our planet safe and a great place to live for everyone. Thank you. Sonar? Yeah, sure, I'm done.
Sure.
Yeah.
Thank you so much, Bar. These were very insightful. Sorry, let me turn on my camera. Okay, thanks so much, Bar. Your presentation, very nice to give us perspective about Kazakhstan experience, both for the government policies and also recent financial market initiatives like green bonds and green loans, and also how the new rules and regulations will be at the play for this thing. Thank you so much. This was a great presentation that gives us what the emerging market perspective is. So the next speaker is Charlotta Groth. Charlotta, please, we are very happy to hear your views about the interplay between finance and climate change.
Sorry, Charlotta, you're muted at the moment.
Unmute. Now you can hear me, yes?
Yes, we can.
And you can see my screen as well, is that correct?
Yes, we can.
Very good. So thank you so much for inviting me. It's an honor to be here, and I listened to the previous sessions, and it's all very, very interesting. So I'm really coming to this as a practitioner, as someone who works in the finance industry. I'm at Zurich Insurance Group, which as an insurance is affected by climate change related risk from both sides of its balance sheet, both on the insurance side, of course, and also on the investment side. And I personally work on the investment part, so really looking after the assets, and that's what I will be focusing on. So my day job really is to look at interest rates, inflation, and global activity. But over the past 5-6 years, I've been spending an increasing amount of my time on climate change, because it is probably the most complex and important risk for financial sector to understand. And it's something we cannot hide from. I don't believe there is such a thing as a smooth and well-behaved transitioning scenario. And I think the previous speakers kind of motivated why that is the case. One thing I've been working on is kind of a data-driven approach to try to measure and understand the trajectory of a climate change. And throughout these years when I've been looking at it, the message has been very clear. Simply speaking, we're not on track for a 2-degree scenario. And the COVID crisis didn't really change that. We've seen the very sharp rebound in the global economy, which means the carbon emissions will increase again. But I think something we've been seeing here in 2021 have been very important, and maybe that trajectory is shifting. So earlier this year, back in April at the Earth Summit, major economies representing roughly 50% of the global economy, they brought forward or accelerated 2030 targets around CO2 emissions. So net zero targets for 2050, they are extremely important as a long-term goal, as a vision, but you cannot really track where you are relative to those targets. And moreover, there is very little accountability because it's so far away in the future. So it's difficult to hold anyone accountable today for whether you're reaching or not those targets. So for that reason, I think these 2030 targets are extremely important, and they are ambitious. And I'm showing here just what they mean. And we have previous speakers talking about exactly these targets. But basically, a decline of 40% in CO2 emissions over this decade will be required to reach them. And that's a huge effort. And I think Professor Dasgupta mentioned that that's basically one COVID crisis every year. And of course, we know that that's not really feasible from a societal or political point of view. And that's exactly where these investment and financing needs come in, because you need to decouple economic activity from carbon emissions. And that's what requires in this investment. You need to invest in these new technologies, in the electrification of the economies, etc. And funding needs are huge. There are big numbers being played around with. One I usually refer to is 90 trillion over the coming 15 years for both the energy sector, for the transport sector, for infrastructure more generally. So it's absolutely clear the governments cannot do this on their own. They need to set the agenda. They need to provide leadership. They need to provide certainty around the institutions and the commitments, because that's really how you get down risk premium around this investment. But we need the financial sector, we need private sector to leverage and to scale up the investment into the greening of the economy for this to work. And similarly, we're getting a lot of news as we speak out of the COP26. My own company, we've been a member of the Net Zero Asset Owner Alliance for some time. That's an alliance of pension funds and insurance companies. Currently, roughly 10 trillion assets under management. But the reason we are mentioning now that for some time, these companies have had net zero targets for 2050. But what has changed over the last year or so is that a number of companies are now coming up with these interim targets. So similarly to what the governments are doing, they're actually putting in place 2025 targets in terms of carbon reductions that they are committed to make over the next 3-4 years. And it's important first because you need to think about what that strategy looks like. It really highlights the trade-offs that are involved. And there is also accountability to these targets. I think this is something, when we're hearing about all these big numbers, we really need to focus on what are the near-term roadmap to make sure whether or not this is happening. I spoke about trade-offs, and clearly if you want to reduce CO2 emissions, you might have to give up, or at least you have to know what the trade-off is in terms of your other targets, in terms of your investment income or capital gains. And I think to understand and explore that trade-off, that's why it's so critical. Two things are really important. And I'm kind of making a plea here, and of course this is kind of an obvious point, but a carbon price that really helps that thinking through what the near-term strategy should look like. It's going to tell you what the trade-offs are. It's going to help to drive investment flows, and it's going to help to avoid misallocation at a global level, because there are huge sums of money potentially being channeled into these sectors. So we want carbon prices because they can help us as investors to guide that allocation decision. Currently, too little of the words carbon emissions is covered by carbon price, and it's too low. And it needs to be high enough to really drive change to be meaningful. And we heard a lot of different numbers today. It needs to be meaningful, and it needs to be disruptive to make a change. And I think that's a key highlight. The other one is really a practical point of view, data. Data needs are really, really huge to try to decarbonize investment portfolios. You need to scroll through and look at thousands of companies, maybe on a quarterly basis, to understand what targets do they have in place, what are the carbon emissions, what should we expect going forward. And that data, there are some very encouraging initiatives coming out of COP26, but I would just like to highlight that. And particularly when we think about emerging markets and the smaller and medium-sized companies, which really need funding, data issues are quite challenging. And I think this is something, it's not so, it's quite basic, but it's really something that needs to be done over the next few years to accelerate this transitioning. Now, my final slide, so far I spoke very much about decarbonizing portfolios and moving away from the bad stuff. But of course, we really need to scale up finance to move into the greener parts of the economy to help support technology and innovation in those parts of the economy. And we've seen a lot of numbers being thrown around. The latest one was probably $130 trillion US. I think it's great that so many financial institutions want to be part of this journey, because that's what's needed. But I think we also have to recognize the constraints that are facing the industry, the investment industry in general. For where I'm coming from as an asset owner, it's really asset and liability management approach, where you're trying to match your investment to match your liabilities. This is a way of containing risk in your portfolio, and it has served the industry well over the past decades. And those kind of constraints mean that your capacity to move into exotic investment vehicles might be very small, although your portfolio as a whole is large. What we do know is institutional investors do need a lot of government bonds. And to be able to invest into a specific asset, you need scale. You need to be able to move in scale to go in there. And this is why I'm highlighting one of the asset classes, green government bonds, especially sovereign green government green bonds. This is an asset class which, from an investor point of view, as an institutional investor, it's something that you can put on your balance sheet. It fits in with the current constraints, and there's already a vehicle in place. So you could quickly scale it up and use it to channel capital into the greening of the economy. It's an underutilized asset class. So although green bonds have increased and grown a lot over the past decade, if you look at the share of government green bonds in that, it's still relatively small. And also, if you look at sovereign green bonds in the universe of all sovereign bonds outstanding, it's tiny. So there is huge scope to scale up these green government bonds. I think the critical point here will be, what's the use of proceeds? How do you use the proceeds in the most clever way to scale up finance, to be able to channel it into emerging markets, for example? So a couple of points here. These green bonds, they need to have a project designed. You need to show that you're using this specific pool of money for something which is green. And one suggestion, and it touches back to Professor Dasgupta's presentation, would be to make it possible for governments in developed markets, so the major economies, to use some of the proceeds for actually investing in projects which are in emerging markets. So that could be one way of making this greening of the economy more equal. And of course, also to live up to some of those promises regarding fundings that have been made in the past. Another one could be nature-based solution. And the third one, coming back to the role of risk and the government absorbing some of that risk in the greening of the economy in order to leverage more private capital that can be channeled into those parts of the economy. And I think we heard an excellent presentation earlier on today on why that might be a good way of moving forward, and it's been used in a very favorable way around the COVID crisis. So on that note, I leave it, and I'll pass on to the next speaker.
Thank you, Charlotta. Thank you, Charlotta. It was a great presentation touching many practical issues from a practitioner perspective, but lots of policy-related practical issues like how we should set the targets, what is the role of accountability, and how can we avoid various uncertainties, including the policy uncertainty. And for those things, we have notes about the data needs, also widening the assets that can be used by the financial institutions. Otherwise, it will be quite a difficult transition to a greener world. Thank you so much. And I have noted down my questions as well after the presentation. So our next speaker is Christian. Christian will also giving us private sector perspectives. Thank you so much, Christian, for being with us today.
Thank you. Thank you very much, Sana, and thank you for the invitation. I'm actually joining from Glasgow, where it has been a very hectic few days, especially yesterday with a lot of announcements on finance and financial commitments, including from HSBC, but also from many other institutions. So I'm running sustainable finance for HSBC, and Charlotta, I think what you said was a fantastic introduction or outline of the things that need to be done, and this need for system thinking on a very complex issue, which is the one of financing the transition to net zero. What you said about the scale and the magnitude of the challenge is something that we very much have in mind, and this need for collaboration among various actors, you know, from policymakers setting clear signals, and you mentioned carbon pricing. I think that's critical, but also when it comes to investing in emerging markets, covering some of the risks which are still very unpalatable to many institutional investors, and preventing mobilization at scale. So the role of public sectors, multilateral development banks, and so on and so forth. So we, as HSBC, we are trying to do our part in this collaborative endeavor. We have like many other institutions, made some specific commitments in terms of accompanying the transition to net zero. We have allocated between $750 billion and $1 trillion over the next 10 years to help our clients transition to net zero, and to facilitate a very difficult journey, especially for many of our clients with our footprint in Asia, where energy needs are rising significantly, and where there is still a pretty strong dependency on very high carbon sources of energy. So we've made some specific commitments in terms of funding, and maybe more importantly, we believe that we have a role to help unlock capital, to help mobilize those trillions of dollars that are needed. The issue of capital mobilization and private sector mobilization is a really difficult one, because when it comes, to well-prepared projects, even in very difficult geographies, there is ample capital when it comes to renewables in the developed markets, but also in emerging markets. If they are what we call bankable, if they are well prepared, there is a lot of capital, but there is a scarcity of bankable projects, and I think there is a scarcity on the upstream side, and a mismatch between the needs and the actual availability and actual pipeline of projects. So how do you, as a financial institution, help change this situation? And in order to do that, you really have to tackle both the supply side and the demand side of sustainable projects and infrastructure projects. So we've been involved for the last few years in a few, I think, groundbreaking initiatives which are collaborative in nature. We, for instance, together with the IFC, we put together a fund to invest in green bonds in emerging markets, but in corporates. It's called Regio, and we raised $500 million last year to invest in emerging market green bonds and favor and encourage the development of green corporate bond, the green corporate bond market in emerging markets. We have also a few weeks ago announced a groundbreaking initiative with Temasek, so one of the largest institutional investors in Asia, sovereign wealth funds, to provide financing for projects in sustainable infrastructure in Southeast Asia, which are marginally bankable. So typically the projects that HSBC would turn down, would not look at. And because we teamed up with the Asian Development Bank and with Clifford Capital, which has a lot of expertise in the field in Southeast Asia, Singapore in particular, we believe we can provide a mechanism that will help scale up and increase the pipeline of bankable projects in the region, focused again on climate and sustainable infrastructure, so renewable, waste to energy, water, and others in Indonesia, Philippines, Vietnam to start with, but it can expand. And yesterday we announced that we would look to join the Asian Development Bank in this new energy transition mechanism, which has been conceived as a way to accelerate the decommissioning and the early retirement of coal-fired power plants in Southeast Asia. So it's a very innovative mechanism which is meant to provide additional funding for increasing renewables capacity, but also funding to help retire early coal-fired power plants in Asia. But really, I mean, those initiatives are great, but if you want to scale them, you need to think about standardization, and you need to think about how the system as a whole can work. And here to move from the billions to the trillions, we've launched a couple of initiatives which I believe will can play a critical role. We, as part of the One Planet Lab, we have led a coalition involving multilateral development bank, financial institutions, institutional investors, NGOs, civil society, and governments, and others, to look at what was missing in sustainable infrastructure to move from the billion to the trillions. And one thing we have been focusing on is the definition of what sustainable infrastructure is. So yesterday, we announced the establishment of a label called the Fast Infra label, which is the first label which defines the characteristics, the sustainability characteristics of a infrastructure assets. It has 4 dimensions: ESG and climate resiliency, and criteria underneath. And this will be, like for the green bond principles or the green buildings, this will be the first label that will define what a sustainable infra asset is. And we think that's really important because it will allow institutional investors to be much more comfortable as to the sustainability characteristics of the assets they invest in. And we think that will have a catalytic value in attracting private capital to sustainable infrastructure globally. And it will also provide a very strong signal to developers, to governments, to sponsors on how to develop an infra asset so it meets the sustainability criteria, so it becomes bankable and becomes easier to finance. We've done that with the Global Infrastructure Facility, with Macquarie, many other institutions, and we launched it yesterday. The second thing we're doing is use technology in order to facilitate and accelerate the development of sustainable infra projects in emerging markets, together with a few financial de-risking mechanisms to bring the likes of insurance companies into the space. So this is a really collaborative approach that is meant to provide some standardization and to facilitate the mobilization at scale of finance. But it's a complex issue. It needs collaboration. Sustainable infra is one thing. You mentioned, Charlotta, nature-based solutions. We're also participating in the various initiatives to scale up and standardize nature-based solutions. We launched a fund to invest in carbon credits, but also in assets which will increase, or which like reforestation, sustainable fishery that have a carbon absorption objective. And finally, we're also investing in new technologies. You said it very well, Charlotte. I think we need to help unlock capital to promote the development at scale of technologies which will allow for carbon capture, but also green hydrogen and sustainable aviation fuel and others. So that's in a nutshell what we're doing.
Thank you so much, Christian. This was very insightful. And in particular, you emphasized the point that it's not only the quantity of funds, but it's also the scarcity of the bankable projects, and how it is important to have that matching function between the supply of funds and the projects, the bankable projects that needs to be realized throughout this transition. And also another important point I took in my notes was how it is important to have the collaboration between the private financial institutions and the multinational development banks to find what the bankable projects are and how they can be realized. Thank you so much. And next we are going to have Mr. Ding Yifan, who is going to give us his perspective about the interplay between climate finance and the climate change.
Okay. Thank you very much. Thank you for your invitation. I'm very pleased to share some of my analysis on Chinese green finance role in reaching net zero targets. So I will prepare to say PPT. I'll try to share with you my analysis on this. So So China is committed to reaching carbon emission peak in 2030 and carbon neutrality in 2060. So objectively, Chinese efforts will be harder than other countries, just because China has a shorter time to reach this target between the carbon emission peak and carbon neutrality. Within 30 years, we will reach this target. It will be very hard. And also because China is still in the middle of industrialization, however, China promised to attain these objectives, and technology innovation together with green finance will be key factor of Chinese success. So China's green finance really mainly on 4 aspects. Today, I will talk mainly about China's green finance role, let alone the aspect of technology innovation, because China will rely mainly on technology innovation to solve all these problems of emission, while those on Chinese green finance role, we rely mainly on these 4 aspects: green credit, green bonds, pollution insurance, and carbon finance markets. In terms of green credit, Chinese banking system is promoting credit related to green development. Banks, especially state-owned banks, have a duty of allocating a certain ratio of credit specialized on reaching energy efficiency, so on CO2 emission reduction. So in all these sectors, Chinese banks will allow a proportion of their credit to, especially to these activities. And banks, also commercial banks, have special channels to small and medium-sized enterprises, especially for green credit. Certain banks also will allocate credit to firms with pollution reduction progress as collateral. You know, in terms of credit, sometimes banks have difficulty allocating credit to firms because some technology firms have no collateral. They have no mortgage to for unlock credit. Well, in that cases, some banks could take their commitment to pollution reduction or to emission reduction as collateral to give them credit to finance new activities. That's a sort of financial innovation in Chinese case. Capital market. Capital market play a very positive role in promoting carbon emission reductions. New energy companies may raise funds in the capital market by issuing green bonds. So green bonds is issued in Chinese capital market. For example, Chinese nuclear companies issued green bonds, and China is promoting more than 6 models of 4th generation nuclear power plants, including thorium-based molten salt reactor power plants. That's something very complicated, but it's the first time that we will put into practice a thorium-based nuclear power plant. Thorium, as a material for nuclear power plants, is safer than traditional uranium power plants. It's more efficient and produce much less waste than previous nuclear power plants. By using thorium as the basis for the nuclear power plants, the waste represented only 1/1000 of its materials. So in the future, if we treat those nuclear power waste, it will be much easier than we treat nuclear waste with uranium power plants. Moreover, technological companies related to carbon emission reduction may be listed on capital markets. So that's also a way those new technology companies can raise funds on the capital market. So more than 147 companies are listed and considered as specialized in green development, 40 on Shanghai Stock Exchange, and 107 are on the GEM, Groth Enterprise Market, in Shenzhen. That's a Chinese version of Nasdaq. In the future, as in Beijing, we just opened also a new market for exchange for those stock exchange. And this new market opened in Beijing will be also specialized in trading with new technology companies. Pollution insurance, that's also a financial innovation in China. Since 2007, some regions in China started experiencing pollution responsibility insurance. Financial institutions may provide insurance to manufacturing companies that may encounter pollution leaks in their production to ensure that those companies those financial institutions could cover the kind of pollution leaks. Those manufacturing companies will buy those insurance. So more than 250,000 enterprises have bought such insurances against pollution risks with a volume surpassing 6 billion yuan. So over 1 billion US dollars, no, over 10 billion US dollars, something like that. So carbon finance markets, the last the last of these green finance sectors in China is the carbon finance market. China's carbon finance market is opened on July 6th this year in Shanghai. So more than 18 million tons of CE, there's a right of emission exchange. There are more than 2,162 power companies involved, representing more than 800 million yuan up until now. So it's still a small market, just opened for several months, for 4 months. So we have to wait for a while to see the effect of the financial market to the carbon emission reduction, because the target is to provide some instrument for companies that will try to utilize new technology to lower their carbon emissions. So Shanghai is the location of the new carbon finance market. Shanghai is committed to becoming an international green finance market. Shanghai is a green finance market have made a plan of their future development on 4 aspects. First of them, so they were developing a mature green finance market by every way. Second, they will support the capital market to better serve the green transformation upgrade of industries that will provide necessary fundings for those companies that wanted to be engaged into green transformation. The third aspect of Shanghai's green finance market is they will establish a disclosure framework in the financial market for environmental, social and governance, so ESG's information, that to ensure future investors that all these companies that raise funds on the green finance market will be qualified for their future development. The fourth aspect of the carbon finance market is that Shanghai is committed to strengthening collaborations with international financial institutions on green finance. As just we have opened this market very soon, so in the future, international capital is welcome in Shanghai to finance, to add more expertise and capital to these newly born markets to help China's industry to lower their carbon emission and to promote new technology that could lead to no emission, especially hydrogen technologies in China. So that's my explanation. So I think that my explanation is shorter because I'm only focused on the aspects, different aspects of China's green finance market. So that's all. Thank you very much.
Thank you very much, Mr. Deng Yifan. This was very insightful presentation about the Chinese perspective on green finance. And we have taken notes about financial innovations and interesting aspects like using pollution reduction progress as a collateral. I think we will have very lively discussions after the meetings. Let me now give the floor to our last speaker, Ms. Changhua.
Yes, thank you. Thank you, Chair. And also apology for a little bit sort of drifting away because I have another sort of media interview and talking about China's, climate impacts, adaptation, resilience. But anyway, so I probably missed 1.5 presentations for this panel. Hopefully somehow I will find the opportunity to catch up. But other than that, I've listened carefully actually to all the great presentations. And particular Professor Ding has already offered this green finance dynamics in China. So that's really helpful. And so I will save some time on that. I will probably, the contribution I would like to bring to this conversation is more like adding a little bit more insights from China. As we already been talking about, China somehow today hosts this, I call like a make it or break it sort of situation for a global effort to achieve net zero carbon emission by or around the middle century. Because China today accounts about, 30% of the global emission, between 1/4 and 30% there. So this is literally the size of the, I call it bending the curve endeavor this country actually is literally taking on. So I'm going to probably help deep dive a little bit actually from 4 perspectives. One, give you a little bit of sort of short, concise interpretation of China's NDC, latest updated NDC, trying to lay sort of a framework for you to understand, what the China is planning to do, particularly around the time-bound targets. The second part, I will help you a little bit actually understanding this is sort of decade by decade sort of roadmap, and not only in the last couple of decades, but more like looking to the future. Thirdly, I will probably deep dive a little bit actually on the policy design thinking, where China stands today and, where we're moving tomorrow. And finally, touch a little bit actually upon the finance because of the topic, the theme of the conference here is about the finance. But as I said, Professor Ding has already offered more details actually of the latest program there, but I'll just add a little bit actually sort of observation on that. So firstly, let me just share a little bit actually this interpretation of China's NDCs, updated NDCs there. There are many numbers, timelines there as well, and like all the others, probably countries' NDCs there. But particular around the carbon, capping carbon emissions and the carbon neutrality targets, I think the 3 sort of interlinked, interdependent sort of targets are pretty much sort of representing the country's commitment looking into next few decades. One actually set strategy, I call it decoupling. This is not a new effort. This has been going on, but of course, China definitely is going to go moving forward more. This is around about really to control the total energy consumption. Of course, coal is in that concept there. But very importantly, the country has been making tremendous efforts in terms of, intensity targets, improving efficiency, productivity, around the 2 sets of targets. One is energy efficiency. The other one, of course, we call it a carbon intensity there. So that's one pillar of the commitment in the IDC. The second pillar, I call it switching from fossil fuels actually to non-fossil fuels. Of course, this, as we're talking about here today, this part needs to be accelerated or scaled at a much faster pace actually. So China definitely has been on the track and definitely going to moving forward. And the third set pillar, I call it invest in nature, particular, represented in the NDCs actually, China's NDC is around the forestry coverage there. So you started to understand, so on the, decoupling side, we had this carbon intensity target, which is sort of carrying on, in the last 10 years, now moving into the second sort of path. So now we are where China stands today. In terms of carbon intensity, we are at about almost 16% reduction. 48% reduction over 2005 level. So that's a representation of decoupling. And then, of course, by 2030, the commitment is to getting to somewhere definitely above 65%. That's upgraded from 60 to 65% to more than 65% now. On the switching part, basically, so China's energy structure continues to rely heavily on coal. So coal accounts for about 56% of the primary energy structure now. And so if you look at it today, we are at about 15.8% non-fossil fuel in the primary energy structure there. Now we are achieving 20% by 2025 and more than 25% by 2030. And then the third one is about forestry. Now China stands at about 23%. Now we are committing to 24% by mid-2025 and more than 25% by 2030. Now, if you look at the number, one question probably everyone is curious about is China committed to cap its emission before 2030. So would all those numbers actually add up to get there? No one knows exactly. You probably hear a lot of countries, including Prime Minister of UK, I think a couple of days ago, said, how about 25%? Honestly, it's really hard to tell. Domestically, as a policy analyst, we've been trying to figure out whether we would be able to move ahead as soon as possible because I said it before, but I have to be honest, actually, no one knows at this moment because it's not simply about saying a number. It's much more complicated than that. But at least actually, that's a sort of this coming decade, I call it bending the curve decade there. So that's the first, of course, we have 2060 target carbon neutrality before 2060. By then, besides carbon neutral, there's one particular number there said China's primary energy structure will be 80% non-fossil fuels. So that's going to be a dramatic shift of the energy structure. So that's one element to help you understand and say, yes, we have all those numbers there. China definitely has been on the track, but somehow there's still tremendous uncertainties there, particularly around bending the curve, by the end of this decade there. The second element is around roadmaps, actually, and particularly looking into the 21st century. So I call it the first 10 years between 2000 and 2010. This could be the first decades. I call it just called China's expansion because just within the first decade, China definitely became the largest emitter, exceeding all the others, and its emission continued to grow there. And this happens to be the journey. Actually, China is aiming to redouble its GDP between 2000 and 2020. After we achieved the first quadruple actually growth between 1980 and 2000. So you could imagine this accelerated urbanization and industrialization process. Of course, infrastructure, industry, everything like that. So yes, China suddenly became the world's largest energy consumer, largest carbon emitters there as well. But in that context, a couple of conflicts started really becoming dominant in terms of constraining the growth. One is pollution. This is related to air pollution in particular, because this is a health benefit there as well. The second one is climate change, because global community already started embracing the climate change challenge there. And the third is resource constraints, scarcity, basically. So you're starting also to say that, yes, while we continue to pursue this economic growth agenda, but somehow we have to figure out actually how to make sure we manage or put our hands around those three constraining factors as well. Moving into the second decade, between 2010 and 2011, 2020, we just passed actually. This is a sort of fascinating decade in a way. So yes, China's economy continues to grow relatively high, but slowed down dramatically. But somehow the country started to roll out some major strategic shift agenda, not being stuck in the old industrial revolution sort of context there. So a few highlights. One is called China Make 2025. This is about manufacturing. And related to that, something called strategic emerging industries, particular 7 in the beginning. Now I think expanded to 11 or 12 already. This is around sort of a more advanced technology industrialization process. Then we started to roll out something called energy revolution. and not only production, but also consumption, policy mechanisms, governance technology there as well. And then actually the new infrastructure, which was rolled out just a few years ago. So you have all this flagship national strategic agenda started to shift. On one side, we need to continue to grow the economy. In the meantime, definitely the country wants to grow the economy differently. In that context, actually, to add the carbon element there, as I mentioned, China started to really, putting efforts into sort of decoupling. That has been a going process. And in the meantime, actually growing dramatically the renewable energy sector. Just to highlight a couple of achievements. So just the last decade in particular, so China has become the world global leader, actually around the solar, wind, EV, storage, and even super high voltage grids in particular, just to highlight those few. Leading global efforts, meaning manufacturing capability, supply chain capability, definitely leading. Domestic deployments have been growing up dramatically. In the meantime, China started also supporting, the world in terms of, the clean energy transformation, like in North America, Europe, you name it, among others there. So the numbers have been very impressive. So if you look at even last year, China supplied about 60 to 70%, solar PVs, wind turbine, equipment of devices there. If you look at EV, last year, China literally provided, manufactured 50% of the global EV new growth. And then if you look at a battery, a few Chinese leading companies provided up to 70% of global EV battery supply there. And of course, then grids have been continuing to, grow there. So that's sort of the decade we just passed. Now we are getting into this decade. I call this decade bending the curve, right? I don't need to elaborate to say why China needs to bend the curve. Literally, China has to, on one side for its own sake, but of course, as part of the global community, China has these obligations there. Besides all the things I mentioned, definitely will be sort of moving forward. One particular new element I would to highlight is something called the National Energy System redesign or reshape, with a particular focus actually around, say, how do we make sure the national energy system is no longer so fossil fuel based. We need to switch that actually to non-fossil fuel based there. That's going to be a major effort actually of this decade. In order to do so, we do need infrastructure to enable, to support that sort of transition there. So if you look at China's efforts, national thinking, particularly around, I call it the third industrial revolution sort of era thinking, taking advantage of the technology progresses. So China is literally, has been, and will continue to be even more so, to build and enhancing its infrastructure around digital, linking digital technology, renewable energy, as well as EV, I call it, clean energy mobility and transportation there, plus, supported by this, this grid, smart grid systems there, plus the buildings there, because buildings today no longer just buildings we live there, but also it's a data center and also energy center there as well. And then you start, I think those are going to be two major sort of highlights of this decade. Yes, of course, with all the renewable energy, whatever investment we need to make, but in order to really do this systemic shift, so this is where this country is at this moment. So yes, a short term is difficult, but somehow where China stands today and moving towards this end of the decade there. The third highlight is just briefly actually on the policy. So China probably is different from many other parts of the world. It's still sort of united, centralized sort of governance mechanisms there. So what's happening now in China domestically, everything, all the pieces are moving. Why? Because this new NDC, this carbon capping before 2030 and the carbon neutrality before 2060 is now regarded as has to be put at the center of all government policy making. Besides that, and also nature, we need to invest in nature as well. So from the planetary, boundary perspective, capping emissions, carbon neutrality, as well as nature, those are the three probably representing pieces of the puzzle that are being integrated actually into the policy making. Then on the other side, of course, we have to called people-centric. China is a large country, it's 1.4 billion people, and still, yes, we are out of the extreme poverty, but somehow we still have, maybe nearly half of the population, 40% of the population still having this $145 per month. So they are still poor, right? So this is complex situations there. So in order to make sure the country will be able to really do this shift, systematic, integrated sort of shift. So policy making has to make sure we'll be able to address those key crucial elements really well, right? In order to say this is orderly transition and wouldn't really create chaos, whatever stuff like that. And that's a huge task, right? This is a huge country, second largest economy, more than 1.4 billion people. This is not easy at all. To make it complex, actually, the situation, I think a part of the elements, previous panels, when I was listening, mentioned there already, national security risk has become a really dominating factor globally, and of course represented by US, China, and it's really difficult to address, right? Laws, regulation, even EU also be part of this sort of landscape there. We need to build up, the borders, barriers, shields, whatever, because why in the name of national security? And China has been literally positioned by the US as adversary, rivalry, bad, evil, whatever stuff like that, demonizing China, stuff like that. That's really complicated. And that has some major impact on China as well, because China is very globalized, its economy, its trade, its investment, whatever stuff like that. So somehow that's adding a layer of complexity there. Second layer of complexity is really around say, yeah, we cannot just invest building infrastructure, whatever, just energy. Somehow we need to address this people element. So equity issue, inclusive issue, we need to be prosperous, resilient, sustainable. I don't know about you, I'm a policy analyst. So it's overwhelming in a way. Say, how do you make sure the policy design is designed that will be able to address that part really well? I'm not sure, we really have the final answers there. But all in all, I think the policy thinking is ongoing now. This whole country is trying to figure out how to pull all the pieces together in order to make sure we really design the policy framework to effectively incentivize this supporting, enabling, incentivize this transition there. Lastly, finance. I'm glad that Professor Ding already shared the more details of that. So finance definitely has to be part of the solution, right? With all those policies coming together, finance has to be solid there. So compared to many other parts of the world, for China, the mindset today is no longer just using this one or that particular financial products or tools. It's everything. Everything has to be together. And that's difficult, right? And but that's the only direction to go. And yes, we have carbon markets, we build up a capital markets, funds, insurance, you name it, actually everything. Again, it's a very interesting landscape to watch. And somehow I don't think anyone today has the final answer, but somehow the whole country's mindset is fixed on this sort of particular decade to say we have to bend the curve. It's a huge task. Of course, China has to take on its responsibility, but more importantly, China has to work with the global community in order to get there as soon as possible. Thank you.
Thank you, Ms. Wu, for your presentation on how China's role has been in this transformation in terms of new technologies, new policies, and also thank you for giving us a deeper perspective about the China's national determined contributions. So now I think we have time for some questions and discussions, and let me look at the Q&A. Okay, let me start by two questions here. The first question is from Sayuri Shirai, and the questions for Charlotta, but other panelists, please feel free to contribute as well. What do you think about twin bond approaches, regular sovereign bond and green sovereign bonds adopted by Germany? And let me also ask the second question, because second question is related, and also it's for Charlotte, but please feel free to contribute, other panelists as well. So this is from Deepak Dasgupta, who says, I'm very happy to hear your views about both risk and sovereign bonds. How are sovereigns receiving message from financial industry? And what is their perspective? What is their receptivity given fiscal treasury worries? Yes.
Okay, so maybe I kick it off then. So in terms of the twin bond approach from Germany, I think it's like with everything in this field, we don't know the solutions yet, and we need to test many different approaches. So from that point of view, I think that's a great idea. It's an innovative idea. So basically, you're trying to match all your normal bond issuance and also have a green bond with the same date, the same maturity, the same coupon, and that should help the liquidity in the market, and that's super important for an investor. So I think it's a good approach. It's probably not the only one, and different countries are doing it in different ways, but clearly there is an understanding of the constraints from the investors including around liquidity. I think that's what we're seeing in terms of debt issuance. I mean, on the other questions, what's if the governments are kind of receiving the message, and I would say yes. We have a lot of new countries that have entered the green bond market this year. We had an EU-wide green bond. That was the most interesting one. So it's financed by the EU at a supranational level to support spending on the next gen, on the recovery fund in the EU region. And demand for that bond was very, very, very strong because it offers exactly what investors feel they can contribute to, and of course, even more kind of diversification in their books. We also had the UK and Germany already entering the bond market. I think it comes back to something we touched on, which is, I mean, the challenge is really to come up with projects. We're seeing it also in terms of the recovery fund, where countries have to find green projects that they can propose to the European Commission, and then they can get the funding. And that's a constraint because right now the global economy is running at full capacity, and you can only have so many greening or construction projects going at the same time. And that comes back to the thinking around the proceeds. Could we be more innovative there? Could we think about other way to use the proceeds of the green bonds? So I think in terms of issuance, yes, interest is really there, and we're seeing new issuance, and that's great. In terms of proceeds, I think that will be the next step to really consider going forward.
Thank you, Charlotta. Christian, I know you are very generous to be with us despite your very tight agenda. So would you like to comment on the question, please?
Just say a couple of things very quickly, and I'm sorry, but I will need to drop off. But yeah, there is an enormous, very fast development of the green bond market, and not only the green bond market, but also the sustainable market and social bond market. We are probably going to see $1 trillion of issuance in 2021. For the first 9 months of 2021, we were, I believe, at $777 billion, 777, of issuance, up 60% from last year. And there is indeed diversification also to emerging markets, so more and more emerging market issuers issuing green bonds, but also SDG bonds, social bonds, sustainable bonds, sustainability-linked products, sukuk, green sukuk, and others. So, and I think this trend will continue. We had a survey of investor attitude that we've been doing for some time now, and it shows that there are, I think, if I remember well, 25% of investors that are investing in green bonds today. We surveyed 1,000 investors across the world, and there is an additional 50% that want to increase exposure to green and sustainable bonds. So there is a lot of appetite for that. The issue, will be around standards and around reporting and around making sure that there is soundness, I would say, in the definition and also in the verification process to avoid greenwashing. And I think the regulators are really focused on that now. And I think little by little we'll be moving to a market which will be much more robust in terms of compliance, and where greenwashing will be more difficult. But thank you very much for your time and the opportunity to speak today.
Thank you. It was our pleasure. Thanks so much accepting our invitation despite your tight agenda. Thank you so much.
Thank you.
Christian.
Thank you.
Okay, Mr. Ding Yifan, do you want to follow up with your perspectives on the question? Yes, you are.
Okay.
Please.
That's open. So I cannot control it completely because it depends on your control. So I wanted to add a few words about technology innovation. We should keep in mind that green finance should serve the technology innovation. Otherwise, the green finance cannot solve the problem of carbon emission or carbon reduction, carbon emission reduction. That in China, we have made tremendous technology progress in reducing carbon. And so to recently, a research institute in Tianjin succeeded in making a starch out of CO2, out of carbon dioxide. So that's very useful because we know that a starch is a basic element of food, but also a basic element of industrial production. So this kind of scientific innovation could have a bright future that can raise funds in the capital market, and a lot of technology companies would like to use this kind of technology to build up another business model. So that's very important. If you can use CO2 for industrial production, that could lead, instead of carbon sequestration, you may use carbon for real purposes, real industrial purposes. That's something the new technology will lead us to a bright future. So we won't be bothered only by too much CO2 because we can use CO2 for real purposes. That's my point.
Thank you so much, Mr. Ding Yifan. Bar, do you have any contribution to the question?
No, I mean, this is just general. I think what we have to do is just to be, I think we're talking about sustainable development. I think what another very big question that that was not discussed right now is the circular economy and how we do this. So what Dr. Ding Yifan just said about using the CO2, having the offset, just trying to understand how can we use it better. Because at the end of the day, I think, and I'm an economist by training, so I'm thinking of how to make it more viable and more economically sustainable for everyone, for the businesses. So whenever we talk about CO2, or for that matter, other greenhouse gases, because it's not only CO2, we can talk about methane, we can talk about others. We have to understand and look for the models. I think what is most important, and I think that was one of the expected outcomes of the COP26, is just the role of technology and how we use technology. Because I think at the end of the day, because when it comes to money, it's how we can make it more sustainable, more less costly, and reuse it. So technology is a big question. Of course, I'm not an expert, but then we can see, even right now to talk about NDCs with different countries. And in China, we talk about how it still depends on the fuel fossils. And we see that emission will go up and then go down. The same with Kazakhstan. We depend on coal, we depend on gas. We want to increase the share of we're committed to increase the share of renewables from 3% to 15%, but it means that we have to have cheap technology, cheap solars, cheap wind, and also understand how do we upgrade our electronic grid, because once we move into alternative energy, then there's a lot of pressure on the grid. So I think all the things should be taken into account, and one very big question is like, how do we leverage technology that we have to achieve these goals and achieve these commitments?
Thank you, Bar. Ms. Wu, do you want to contribute to the question?
Sure, just quickly, I think when we talk about the new growth, that's where technology comes in particular, very exciting, right? Everyone is looking for next Tesla, right? And everyone trying to invest in new technologies there. We call it green, right? I think the challenge, which I haven't not heard enough actually, is about this transition finance. And if you look at the current stock, the energy, power sector, whatever stuff like that. And also I think financial institutions in particular recently have been blamed in many, many ways, because all the information out there say, yes, you guys talk about, you're going to commit to this and that. But if you look at where your capital has been or is today, literally, lots of it actually still stuck in this sort of, current sort of stock there. I think that part needs to be addressed really well. And particular for large economies like China and maybe India to a certain extent there. At least I haven't really heard enough. I think that's where probably would require, much more sort of attention, because we all know transition is always a punishing, short-term, long-term. This is a sort of the cost, the pain we have to bear together, society, government, business, we have to bear together. So what does that mean for finance, actually? I think that's going to be a very interesting topic to discuss. Thank you.
Thank you. We have another question from Sayuri Shirai. Charlotte, the question says, some institutional investors say they do not prefer sustainability-linked bonds due to adjustable interest rates. They prefer fixed income bonds. Do you think this is a constraint in terms of developing such bond markets? And please, contributions from other panelists are welcome as well.
Yeah, so the sustainability bonds, then your payout would be linked to the degree of success of the project in that is being carried out, or the promised CO2 reductions or similarly, just for those that are not aware of that. So you would have an unknown cash stream from these bonds. And of course, it comes back to what we spoke about before. I really think we need to try different approaches. There is not one solution to solving this problem because it's so immensely complex. So I think it's great that this thinking is around. I think, as some of the previous speakers said, the demand from investors is huge for bonds that fit into the constraints and that they can put onto their balance sheet. Of course, if you're comparing two bonds very similar, one has a known cash flow and the other one has an unknown, there is an uncertainty and the risk premium might be higher. But it might be justifiable and it might still help to channel finance. I think there is not a good or a bad solution here, and I think we have to be kind of open to many different solutions. Maybe could I just very quickly come back to Ms. Wu's comment in the previous, and I think it's really, really important. It's about the transitioning period. I'm sure we can arrive to some new state of the economy of energy system because we know that renewables can be competitive. But the problem is this transitioning phase where you basically have to move from one system to another system. And I think as an investor, that's the challenge. I mean, we, as many other in the industry, have quite strict decarbonization targets now for 2050 to reduce the carbon footprints in our portfolios. And I think an easy way of doing it would just to simply disinvest from a few sectors that are really bad, or a few companies that are really, really bad. But because we know that these carbon emissions are very concentrated in a few sectors. But those are the sectors they also need to transition. And they are the ones that probably know the energy system, for example. They have the knowledge. And I think that's really the challenge. How do you make sure that there is funding to these old sectors? Because they have the answers to many of the questions, but they have to transition. So I think for me, that is a real challenge. How do you make sure funding still goes to the old company, maybe sectors? No, I shouldn't speak about companies, while also making sure there is transitioning.
Thank you, Charlotte. Any response either to the previous questions or Charlotte's comment? Okay, let me go with one question, and actually this is also partly related to Charlotte's presentation, Christian's presentation, also Mr. Ding Yifan's presentation. One of the mismatches, of course, the supply of funds and the bankable projects. Maybe it is just the semantics, and maybe I'm just talking about the bankable projects. This transformation also requires us thinking out of the box, where we will have new ideas, new innovations. And we know that new ideas, new innovations most of the time don't come with collaterals. Therefore, we may have a very good idea, but we may yet have insufficient collateral to go for a bank and ask for a green loan. So how do you think this will play out as a challenge, and what can we do to pass this challenge? And also, one of the things that I picked from Mr. Ding Yifan's presentation was the pollution reduction progress as a collateral. But this is an intangible collateral, maybe. So how do you think we can still provide financial intermediation in a world where the collaterals are not as tangible as the collaterals of the contemporary system, let me say?
I think I can join in as well, because I think that's where the policy making, that's where the governments, for example, can come in. But when we have the development institutions, when we have the overall funds, that the whole mission is to contribute to sustainable development, I think someone has to take the cost sometimes. And we know the transition is costly, we understand that. But now we should be looking at the long-term benefits, and the governments, that the whole point of the government is just for the long-term public good. And if the government understands public good, and the government sets the mission to achieve climate justice, or just in general intergenerational justice, then it should take the cost. I think that at some point we will have to find development institutions and the governments must develop institutions to take the cost. I think that's inevitable. We have to understand that, and that's why there's a big urge to do so, and it's why there's also some reluctance. There's also, I know we are at COP26. We understand that, for example, all the governments have committed to the Paris Agreement, but then the nationally defined contribution, they also vary from country to country. And then if any government wants to step up, then it has to employ internal resources, and it will come at the cost of the current generation, but for the benefit of the next generations. And it's hard for the companies, hard for the commercial company, which is driven by rather shorter term, like medium term benefits, a medium term return, to invest in this transition. But then the governments, I think the ultimate goal, and even maybe going even further than the governments, some intragovernmental, like the multilateral institutions, like the EBRD or the World Bank, they should be playing the role. In EU, you have this EU fund. They have the programs like Fit for 55, etc., etc. I think that's the role of the large government and supranational institutions, like I just mentioned. Someone has to take the cost. We have to accept that.
Thank you, Bar. Thank you, Bar. Any other contribution to the question?
Maybe I can just say, I echo the previous speaker, and maybe also once again raise the issue of a meaningful carbon price, because that shifts the risk reward kind of trade-off for any given project. There is always a risk, there is always an expected return. And if you have a meaningful and a consistent price of carbon, which is consistent with what we're trying to achieve here, then that should, on the margin, help support these projects as well.
Can I jump in here? I think not necessarily just answering directly to the question. I definitely want to add a little bit more insight actually from some of the challenges China faces today. I know I painted a rather rosy story, the big picture stuff like that, which is fascinating. I feel confident, but somehow in reality, it's much more complicated than that, particularly related to finance and policy design there. 4 things just to highlight. One is the role of the visible hand, the government, right? On one side, definitely it's a great advantage to Chinese government. It's really on it, stuff like that. But then, market has its own rules, right? How the market will work there. So I think the bigger picture around, the planned economy, market economy, where the government says whatever, just recently, the energy crunch or power shortage actually within the sort of the policy community, the part of the discussion is basically say, when everything seems to be going out smoothly, without a crisis, whatever, stuff like that, you started to see the advantage of Chinese system, right? Because you take advantage of both the planned economy, market economy. But then if a crisis occur, like, the energy shortage or crunch we just experience, you suddenly feel like everything fall apart. You're stuck in the middle. So that's one realistic challenge. I don't think anyone has the answer yet. That's going to take a lot of time to explore. The second element, actually, we talked about ETS. China has literally copied exactly the design, everything of EU ETS. Ideally, this is going to be very important, the financing instrument to drive the transition, right? We started with the power sector now, with more than, I think, 2,162 power companies now in the current comply stage there. If you look at the price today, it's been going on there since July 16th. National, sort of trading platform started. It's pretty much around $6 to $9 per ton, right? This is a huge gap. So yes, tools, the instruments are available. We even have the role model of the EU ETS. We learned from your lessons and also witnessing your success, successful progresses there. But put that policy tool within the China context there. We don't know when it's going to really play its dual role in terms of really pricing carbon, really driving this sort of, decarbonization process. Huge question mark there. That's the second one. The third one actually is really, lessons learning from this summer's, even now. I think things getting better now because now relax the coal situation in China. There's a power shortage there. So a huge reflection from the policy making community is that it's a major failure policy design in a way, because we failed to connect the dots, right? We have been driving this environmental agenda, emission reduction, carbon intensity reduction, whatever. With all those happening, we'll be shutting down, thousands of coal mines, stuff like that. Which is fascinating because you see the environmental, if you air pollution, if blue skies actually in China, in Beijing in particular, that's a huge sort of witness there. If you look at the saved energy, avoided emissions, stuff like that, fascinating to see the progress. But then what things happen on one side, the other side, China has been growing very aggressively, installing renewable energy. That's another record there as well. But then when this recovery, post-pandemic recovery happens there, no one expected such a huge sort of a shift, because global community suddenly relied on China very much on manufacturing, providing goods and the products there. So literally it overwhelmed, right? The whatever the energy system there, we started to have this huge shortage of coal in particular. Then adding to that factor, we've been importing coals from Australia, whatever. The geopolitical situation played a part there as well, because we said we're not going to import, we don't want to import coal from Australia anymore. And then you started to see, right, it's a very complex system there, right? Because in many ways, prices of coal, even gas, whatever, that's global, that's world market there. It's not controlled by the government. So it's a connecting the dots issue. It's a supply chain challenge, and then pricing, electricity pricing, because the government has to address this equity issue, right? Because people will still have a lot of people poor. They cannot afford a very high, electricity bill, whatever. So I think China represents a huge example in a way, say, wait a second, yes, we can pursue this agenda, that agenda. Somehow, if we fail to connect the dots, somehow it's not resilient there as well. The last point I want to mention, actually, I know we're talking about energy, right? Infrastructure, clean energy. We know we live in a world of climate change, right? With all those disasters happening there now. How do you really internalize this climate change impact disruption there into your financing model? Yes, of course, you've been looking into the risk, trying to sort of integrate that into the financing system because you care about the risk and the return. Climate risk, you are forced, so you have to look into, this particular risk. But to what extent Are you really, fully considering that sort of element and internalize that and build that into whatever the financing model there? I had to say, I have not seen enough. Of course, the insurance company is the leader in terms of aware of the risk, whatever, stuff like that. But overall, the financing sector overall, I don't think it's fully considered. So those are the sort of four actually sort of highlights to say, look, this is not just totally rosy. If everything is rosy, actually, we probably will get there already. We already bent the curve, but it's not easy at all. Thank you.
Thank you, Ms. Wu. Mr. Ding Yifan, are you going to contribute to the question or discussion?
No, no, thank you. I have no other comments.
Okay. So we have time for one last short question. If not, it has been a long and very lively session, and we are very grateful to all of our speakers for their generosity, for giving their time and contributing to our discussions. So then let me take the liberty of saying this is the end of this session. Very pleased to have you in the panel, and thank you to the audience as well. Our next session will start at 1:30 p.m. GET, so it is 38 minutes from now. And in the next session, we are going to look at the public sector perspective about the sustainable finance. So thank you so much for being with us, and thank you for your contributions, dear panelists. Thank you.
Thank you. Bye.
Bye.
Thank you. Bye.
Bye-bye, Charlotta.
Welcome everybody to the session on the potential role of public policy in sustainable finance. This is really interesting. I'm professor at Glasgow, David Blanchflower. Everyone calls me Danny. There's a reason for it. It's about a nickname I had from a soccer player. I was a member of the Monetary Policy Committee in the Bank of England from 2006 to 2009. So I'm really interested, particularly in these questions. I mean, the big questions here: should central banks adapt new policy mandates and operational frameworks in response to climate risks? That's one big question. How can possible systemic risks due to climate change be quantified and embedded into regulatory and supervisory frameworks? And what role will central banks and regulatory and supervisory agencies play in this context? I mean, this is really obviously a big deal. So we have 5 really very distinguished people to come and talk about this, and I'm going to learn things because I'm not a climate person, but I'm going to learn from these distinguished people. I'm just going to go through it quickly. Each person's got 12 minutes or so, and the simplest thing for me is to just introduce people quickly, and I'll see if I get the names right. I've been practicing, so let's just see if I do it right. And obviously people can ask questions in the Q&A, but here's where we're going to go. Starting off in this order, Sayuri Shirai, who's professor at Keio University, is going to go first, visiting scholar at the Asian Development Bank Institute, former member of the policy board of the Bank of Japan, and former economist at the International Monetary Fund, and obviously a distinguished speaker. Leslie Mazdor, and I've been seeing these people's faces appear on the Zoom thing. Leslie Mazdor, Vice President and Chief Financial Officer at the New Development Bank, former Managing Director and President of Bank of America for Merrill Lynch for Southern Africa, and former Chairman of Barclays Capital, and first African to be appointed International Advisor to Goldman Sachs. Oh, I'm so impressed. Everybody's so impressive. Semai Tuman, Professor of Economics at TED University, former Deputy Governor and MPC member at the Central Bank of the Republic of Turkey. I can't do everything, so I'm going to do a little bit on everybody, and then you can do the best you can. Papuna Lejura, Vice President of the National Bank of Georgia, prior to the Head of Financial Risks and Macroprudential and Policy Division at the Bank of Georgia. And Oyen Sanjasuran, Director of the Division of External Affairs at the Green Climate Fund, former Chairperson of the Global Water Partnership, first President of the United Nations Environment Assembly of UNEP. I could go on. They've got so many qualifications. So this is a really impressive group. So I'll let people go, try and speak for about 10 minutes or so. But we've got to be fair to everybody. So say 12 minutes or so each, and then I'll try and sort of put a hard hit in. People can put in questions. I think we'll go to them at the end, but let's start going here, please. And so, Say and Shirai, if you wouldn't mind going first.
Yes.
So microphones
Yes.
off over everybody, and away you go. And if you'd like to share your screen, feel free to do that. Thank you so much. So Sayuri Shirai is going to go from Keio University.
Can you see it?
Yes,
Can you
I can
see?
see it.
Okay.
Yes, thank you.
So I'd like to make a short presentation about climate change and central banks. So if we look at the central bank challenges, since 1990s, we started to do this flexible inflation targeting, started in New Zealand. And we usually use monetary policy to stabilize a business cycle. And normally we use a very short-term interest rate to influence interbank market. And the time span is usually 3 to 4 years ahead. And then since the global financial crisis in 2008, then many central banks in advanced economy reached the effective lower bound. So we needed to do unconventional monetary policy. So we did quantitative easing, forward guidance, negative interest rate, and last year, average inflation targeting adopted by Fed. And the problem is that now, except this year, many central banks in advanced economy find it very difficult to reach 2%. So we didn't have inflationary pressure for some time. And now many central banks started to look at this climate change. But the one challenge is that the time span is like 30 years ahead up to 2050. So it's very challenging. But why central bank needs to look at climate change? One is that because it influences GDP neutral rate and inflation, and also it influences financial system and financial market. So it directly influences the transmission mechanism of monetary policy. And then there are 4 major approaches which are adopted by central bank. The most typical and the very popular approach is financial stability. So central bank try to look at the banking system and the financial system from macro-prudential perspective, and to some extent micro-prudential perspective. So central banks are trying to encourage the banks to disclose climate change impact in line with the TCFD recommendation. And also some central bank together with financial regulators started to ask banking sector to conduct the climate stress test. According to the NGFS, Network for the Greening Financial System, they recently published a report, and they said about 30 central bank and regulators are either conducting climate stress tests or planning climate stress test very soon. The second approach is that how to include a climate issue into the asset purchases. Now, NGFS divides the asset into 2 types. So one is a non-monetary asset, which means including foreign reserves, pension fund of the central bank's employees, and then some central bank managed sovereign wealth fund. So how to incorporate this environmental standard is one issue. But the growing number of central banks, especially in Europe, started to already do this integrate environment issue into their reserve management. But the more challenging issue is how to incorporate the climate issue into the monetary asset, which means some major central bank did the quantitative easing and purchased lots of domestic assets. So how to incorporate the environment issue is very challenging. So I'll touch on that in a minute. The third approach is that some central bank, especially in advanced economy, occasionally extend the credit to the commercial bank, relatively longer term. And so we can include the environment issue by having the conditional lending based on the commercial bank's investment in the green project and green loans and green bond. The final aspect, most challenging aspect is how to incorporate this climate risk into macroeconomic model. This is very difficult. So NGFS so far came up with the impact of climate change on real GDP and inflation, but then connecting to the monetary policy framework is very challenging. I think many central banks still struggling to do it. Now, one issue is that when we talk about the central bank's asset purchases under quantitative easing, the central bank in Europe are discussing whether the central bank should continue to maintain market neutrality principle or abandon the market neutrality principle and try to apply environment issue, which means giving, central bank can purchase more corporate bond issued by, carbon efficient, green companies, and buying less corporate bond issued by carbon intensive companies. Now, some central banks are strongly opposing to this idea of abandoning market neutrality, and because they said that if the environment criteria is included, then monetary policy will not be, it will be distortionary, what they say. So central banks should maintain, when they do the asset purchases, it should be as neutral as possible. And then some central banks say it's not a central bank job to cope with climate change risk, it's a government job. And then if the central bank starts to abandon market neutrality and starts to select the green company and try to not to purchase bond issued by carbon intensive company, then it's like an area of politics. So government may start to intervene in a central bank territory. But some central bank, especially ECB and the Bank of England, about to abandon this market neutrality. The rationale is that quantitative easing is already generating market distortion. And second, for example, many central bank purchase corporate bond purchases, but eligibilities are set by credit rating. So by doing that, the central banks are already distorting market. And then the ECB and Bank of England want to emphasize corporate bond purchases by integrating environment issue, because this is one of the way to transform corporate sector's behavior. And then by doing that, they can accelerate the timings to achieve net zero emission target. And then final rationale is that central bank can help in contributing to promoting sustainable financial market, because at this moment, sustainable financial markets are not really efficient yet. And so if the central bank starts to purchase some sustainability bond or some green bond or sustainability linked bond, it might help to foster the financial market. And then one more issue is that whether central bank should change mandate. So the primary mandate for the monetary policy is price stability. So currently, the central bank in advanced economy try to incorporate this climate issue without changing their mandate. So for example, let's look at the case of Bank of England. So this year, what Bank of England did is that they didn't change the Bank of England Act. And what they did is that they maintained primary objective of monetary policy should be continue to be price stability, but the secondary objective, which is supporting the government economic policy, including growth employment, this part they made a revision. So this year, the finance minister updated the remit and then redefine this second objective and say by incorporating for achieving strong, sustainable and balanced growth that is also environmentally sustainable and consistent with the transition to net zero economies. ECB is also considering this inclusion of climate issue in their corporate bond purchases, but they also insist they will do it with the price stability mandate. The Switzerland Central Bank also already started to incorporate the environment criteria in their foreign reserve management, but also on their domestic corporate bond purchase under quantitative easing. they already started to include some norm-based negative screening, such as the criteria suggested by ILO or United Nations. Finally, Bank of Japan from December this year is going to introduce climate issue into their one-year lending program to the commercial bank. So this is a conditional lending. So if the commercial bank invests in a green bond and green loan or transition bond and transition loans, then Bank of Japan is going to provide cheap loans. So just to conclude, at this moment, central banks try to pay a lot of attention to climate issue, but probably most popular approach is try to include environment issue into the macro prudential, micro prudential policies with regards to the financial system. With regards to the quantitative easing, it's very challenging because at this moment, as long as the central bank maintain the price stability, then they are going to continue to use the short-term interest rate, and then and then influence all the economies. So it may also support carbon-intensive companies, right, together with green companies. So this is very challenging. So at this moment, central bank just try to maintain price stability by incorporating the environmental issue in some part of asset purchases. Thank you very much.
Great. That was very. I had one. We've got about 2 minutes. So I had one question. Presumably, it's easier to do these things when you're doing quantitative easing, right? Because you talk about that. But normality is going to return, and when banks are not going to be doing quantitative easing, do you want to just talk about what you do? I mean, the last thing you talked about Japan is an obvious way to go, but through QE you can buy green bonds, but when you're not doing QE, what
exactly? Yeah, that's the problem. So I think Bank of England and ECB, they are going to taper very soon. So probably, but after tapering, so they are going to do the investment strategy for a while. So I think they are going to include environment criteria there. But unfortunately, for many developing countries and emerging economy, they don't do quantitative easing. So I think what they can do is they can include a climate issue in their foreign reserve management.
Right. Thank you. That was very interesting. Okay, we're on time. That was an excellent start. Thank you for an interesting presentation. And now we're going to move on. And I see him there. And we're going to move on to Leslie Mazdor, Vice President and Chief Financial Officer at the New Development Bank. You've got about, we're on time. So 12, 13, 14 minutes, if you don't mind. Are you going to share a screen or not?
No, you will just be having no PowerPoint.
We'll get to hear the pearls of wisdom.
The question that have been posed to us now is, what is the potential role of public policy in this path towards a low carbon future, and specifically in fast tracking and growing in scale sustainable finance? I'd like to maybe cover 3 areas in the 10 minutes, and I'll try to stick to my allotted time. The first one is to talk about the changing role of multilateral development banks, specifically against the backdrop of COVID-19, which, as you know, is a it's a global public good, but it is exactly the kind of challenge that, as you know, you cannot solve in one country. It is transnational in character. You can only solve it if you have multilateral institutions at play. So I'd like to just talk a little bit about that. The second point I'd like to talk about is the changing role. How should multilateral banks be redefining their mandates as we work towards a net zero future? And then thirdly, I'd like to talk about specifically the role of regulation and the power of regulation in re-engineering the financial sector to serve the real economy in this new world that we are entering. Starting with the counter-cyclical role of multilateral development banks, what COVID has done, David, is demonstrate how critical multilateral institutions are. And they are often taken for granted. Let me put it very clearly. As you know, multilateral institutions were created in the aftermath of the Second World War. They're only 75 years old, actually. They were created and specifically designed to deal with moments of crises. And in COVID-19, it was the G20 that stepped in first, the World Bank and all of the multilateral institutions who provided hundreds of billions of support to help fight the pandemic. Let me also indicate that some of the most innovative instruments in sustainable finance came from the multilateral institutions. The first bond that was called a green bond was issued in 2007. It was issued by the European Investment Bank, and for 3-4 years thereafter, only multilateral development banks issued this financial instrument. Today, that market is $1.4 trillion strong. What that indicates, David, is how important the market shaping or the catalytic role that these institutions can play, because we are not driven by short-term financial returns. We have longer-term development impact mandates. As CFO of the new development bank, the board does not question me about quarterly profitabilities or annual profitability. It's about the overall development impact metrics which we set for ourselves. As the MDBs demonstrated the role they can play in green bonds, I think going forward, they've got a defining role to play in coming up with new ESG compliant products, new financial instruments that can deal with the new challenges that we are confronted with today. So for example, blue bonds, which is a new instrument that have just been pioneered by the World Bank, where you focused on where the use of proceeds will go towards the ocean economy, will go towards fishing communities, greening your sort of fishing industry, your oil exploration, and so on. So there will be new instruments of finance that the multilateral banks will be able to pioneer going forward. The second key point is this. We have not figured how will we deal with what one can broadly call stranded assets, David, meaning we have all these coal mines, we have all these coal-fired power stations, we have all these industries linked to the carbon-intensive production processes. As MDBs, we are probably the best public stewards, the best holders of these assets, rather than the private sector. To put it simply, if you're an asset manager, or if you own a series of a bank even owning a lot of these assets, at some point in future, today they'll have considerable value, but your traditional discounted cash flow analysis is not going to provide you with a clear indication of the future liabilities associated with those stranded assets. We need public stewards of these stranded assets to manage that process. I guess what I'm saying is that MDBs might have to step in to take over a lot of these sort of coal-intensive assets, because because of our long-term development impact mandate, we will be better able to manage it. The third point I'd like to make is that going forward, MDBs will have to move away from our traditional role of providing capital for infrastructure finance, typically sustainable infrastructure, towards more using our capital in a catalytic way to crowd in more private sector capital. So MDBs, all of the MDBs together, our total asset base is around $2 trillion. If you look at the total institutional investor community, it's north of 100 trillion. If you just take the top 500, you take BlackRock and Amundi and you add them all up, it's over 100 trillion. So we are less than 2% of the overall long-term pool of savings in the world. However, we can play this catalytic role, as I mentioned earlier on. We can use our power, our very high credit worthiness, to crowd in capital. So what I mean by that is multilateral banks are the only institutions in the world, and there's only about 15, 16 institutions that are rated AAA in the entire world. We used to have, before 2008 financial crisis, also many private institutions that had very high credit ratings. Today, it is a very, very small component of institutions in that bucket. The huge value of being highly rated is that you can do credit enhancement. You can use your superior credit rating to de-risk projects. For example, many asset managers will not invest in an individual infrastructure project in Indonesia or in India or in South Africa, but they would invest in a project if a multilateral bank is prepared to take on the riskier part of that investment. In other words, we can credit enhance the project, meaning we raise the risk return profile of the project in such a manner that it meets the risk return expectations or the fiduciary expectations set by the shareholders of many of these institutional investors. I guess what I'm saying in short is that we see our role as moving away from direct lending towards what we call a more catalytic role, mobilizing capital. And the way to do that is, as I just said, to de-risk projects. We will become more de-risking machines. We will look at ways in which we can use what's called blended finance, where you bring in concessional finance or you bring in some donor money. You do all the things necessary to take on the riskier part of the project and then bring in the private sector, who will then have a risk return that they would be comfortable with. So in short, just to conclude, what I'm saying is that the financial sector has a very critical role to play in the transition to a net economy. And the multilateral banks in particular have a unique role to play because we are not driven by short-term considerations. There's no question that, financial sector will always be driven by shareholder returns. Quarterly financials matter for a lot of these listed companies, and that deep pro-cyclicality of markets will always be with us. We are too small to correct or balance that pro-cyclicality, but because we are deeply counter-cyclical, we can at least play a role towards that end. And going forward, in terms of designing policies for the low-carbon future, we need to use our firepower more. There's a discussion underway right now, for example, which the G20 initiated 2 months ago, to put in place what they call a capital adequacy review. In other words, the G20 has said MDBs must look at, are there ways in which they can optimize their balance sheets? Are there ways that they can use their capital more efficiently? And in fact, they will probably go as far as asking whether maybe our leverage ratios are too low, because as multilateral banks, to maintain our very high credit rating, we keep very low leverage. Give you an example, most multilateral banks only have a leverage ratio of 3, which means that for every $3 that you actually lend, you have $1 of capital in the bank. For a normal bank, it is up to 10, 11 of leverage. In short, there are fundamental processes of change underway to reform the multilateral development bank system to be more appropriate for the net zero economy that we are heading towards. And we are very excited as multilateral banks because it will lead to a renaissance in development banking. We have so much a more enhanced role in society today, because the world is not focused on the next, or financial sector now, for the first time, I would say, have 20, 30-year horizons. Very few bankers will have, in the past, would have had a 20, 30-year horizon. Now they must have a 2050 carbon neutrality target. Thank you very much.
Thank you. I'm going to step in and ask another. I thought that was really interesting that you talked about. And I sat this morning and listened to the governor of the Bank of England talking about what the Bank of England was doing. And the conversation you've just given is very far away from the kind of things. I listened today to the Bank of England, I listened yesterday to Jay Powell. Maybe you could spend a minute or two just to talk about what the advanced countries might learn from what you've done, because this is a unique, in a sense, your thing is interesting, but the question in a sense is what do advanced countries have to learn who really haven't gone down this road about the kind of business? In some sense, this is profitable business, right? The trick has to be that. But I think I would like to hear from you, what do the advanced countries have to learn? Because they haven't done these amazing things you've started to talk about, that the multilateral banks have started to do. What's the lessons to be learned, and to say to the others as well from other countries? What can the UK, what can France, what can Germany, what can Japan, what can the US learn that have not been adaptive in the way that you have?
I'd say firstly, just speaking from a new development bank perspective, we are owned by emerging markets. Right. Concerns the paradigm of emerging markets very different as we approach the net zero economy from the developed world. As you know, David, the industrialized world, the United Kingdom, Europe, and the United States, industrialized during a time when fossil fuel prices were not an issue, coal prices were low, etc. And therefore, the imperatives now on a lot of developing countries is that their development path is very much impacted by these debates around climate change. But let's make it direct. In a number of countries in Africa, where I'm from, in Africa, we still have north of 400 million people without electricity, right? There's large volumes of cheap coal reserves under the ground. Do we tell these countries to slow down their path of economic development, because this dirty resource, this coal, which they need to fire their hospitals and their universities and their schools and places of learning and their businesses. If alternate renewable energy sources are not available, what do these countries do? I think the lesson for the developed world, in my view, is that there has to be a fair and a just transition. And these words were captured in the Paris Agreement of 2015. The words of just transition is formally captured there. And this is at the heart of carving out a paradigm where the developed world and emerging markets can at least.
I think that was very interesting. I mean, the one thing I was thinking as you were saying it, you might think in the United States of West Virginia, which is the poorest state in the nation, and it's the state where coal is. And the things you say, this has obvious. I mean, in Britain, you might think there's no coal mines anymore in Britain, but in West Virginia, you might think of it as this is a developing part of the United States. And I was just trying to get to, I thought it was interesting what you said, just trying to get to, what lessons can be learned, but it sounds like this is much the same thing, right?
Absolutely.
Thank you. That was very interesting. Now let's move on, and I'm going to ask the same question as we go, I think, which is that, oops, that's my alarm going. So obviously I'm interested in what lessons there are from other countries. So what lessons are there in Africa to be taught to people around the world? So now we're going to go on to, hopefully here, we're going to go on to Semi Tuman, Professor of Economics at TED University and former Deputy Governor and MPC member. I remember about being an MPC member at the Central Bank of the Republic of Turkey. And to hear from, please, hopefully they're there. Yes.
Thank you, Danny. Hello,
there
everyone.
you are. Great. I hadn't seen you before. Thank you so much. And again, I think the great thing to say to everybody, what can the world learn from your experience? That seems like a great question. So please, away you go.
Okay. Thanks a lot. Hello, everyone. It's a great pleasure for me to be a part of this wonderful program, and I thank the organizers for inviting me to this exciting event. Then you are not alone. My main research area is labor economics, migration, and more broadly applied micro.
It's an honorable estate.
Yeah. but having spent almost 18 years at a central bank and moving from bottom to top there, I somewhat feel confident to claim expertise in central banking. I've recently been interested in the impact of climate change and green transition on labor markets and central bank policies. Today, given the time constraints, I will try to provide a broad perspective about the role of central banks in responding to climate risks. Well, the Central Bank of Turkey does not do a lot yet about this issue, but I will also provide a country-specific perspective about this at the end of my talk. And this is a huge topic and controversial too. I will try to be as brief and concrete as possible. Professor Shirai did a very good job in providing a very concrete framework for the analysis, and I will try to fill a few remaining gaps. It's always good to start with some findings. According to a recent stress testing study conducted by the ECB, which includes more than 4 million firms across the world and around 1,600 banks in the euro area, firms and banks will be severely affected if climate change issues are not addressed ASAP. I'm sure most of you know climate risk includes physical risk and transition risk. Physical risk is defined as the economic impact of an expected increase in the frequency and magnitude of natural disasters. Transition risk, on the other hand, is associated with the cost of introducing policies to reduce carbon emissions and the resulting increase in default risk. The results of the stress test show that firms and banks clearly benefit from adopting green policies early on to foster the transition to a zero carbon economy. Without policies to transition to a greener economy, physical risks will rapidly increase over time, and they will increase non-linearly. And because of the irreversible nature of climate change, this increase will continue over time. While transition costs may be higher in the short term, they are much lower in the long run than the costs of unhindered climate change. Indeed, physical risks are the most significant sources of climate-related vulnerabilities. Banks could also be severely affected under a scenario where climate change is not addressed. The expected losses on corporate loan portfolios are shown to rise significantly over time. In 2050, the average corporate loan portfolio of a bank will be 8% more likely to default under the no intervention scenario than under an orderly transition. When distinguishing between different loan portfolios, the climate-induced impact becomes even more pronounced as riskiness goes up. More concretely, without further climate policies, the most vulnerable 10% of banks may see a 30% increase in the average probability of default of their credit portfolios between now and 2050. So these are the main results of the ECB's the most recent stress testing analysis. As such, climate change is relevant to the central bank's mission of maintaining monetary and financial stability. Climate change and transition to a carbon neutral economy have a potential to affect growth and inflation, both in the short term and in longer term. Clearly, climate risks as a whole expose the financial system to losses, which may impair the transmission of monetary policy. So climate change may have consequences for central banks pursuing price stability as their primary mandate and their other areas of competence, including financial stability and banking supervision. As Professor Shirai mentioned, it is governments, not central banks, who are primarily responsible for facilitating an orderly transition and who control the main required tools. Nonetheless, there are several areas where central banks can and I wish will contribute. I'm going to discuss three main pillars along these lines. The first one is analysis. Central banks need to understand and quantify the potential impact of climate change on the economy and the financial system. So the stress testing exercise that I discussed is an excellent example in this respect. Central banks have excellent know-how in constructing large-scale macro models and developing them over time with iterations until perfection. Perhaps the next task is to incorporate into those models a climate module that can measure the risks and guide policymaking. Well, even now, I know around a dozen of central banks that are in the process of incorporating such modules in their large-scale macro models.
But they've been really bad. I mean, remember those macro models missed the Great Recession.
No. Some central banks, they do really well. I mean, probably they are the less relevant ones, but there are very, especially in Europe, very good central banks doing very well in modeling. Not the Fed or other major central banks, of course. Possible modeling options include incorporating carbon prices, either as fixed parameters or assumptions or endogenous variables. Evaluating the impact of climate policy, this is also another modeling avenue, and modeling the impact of extreme weather events on output and adjusting potential output calculations accordingly based on these climate risks. I think these are all very important areas to enhance our analysis know-how at central banks. And also developing new indicators to analyze carbon footprint of financial institutions, as well as their exposures to climate-related physical risks, is another key area. Some central banks have specific expertise in rating various aspects of firms and financial institutions. I mean, the credit rating. For example, Italy, as far as I know, which can be very helpful in carbon footprint calculations. But I want to highlight that access to granular establishment level data would be key to effectively perform such calculations. So data requirement is another key restriction for analysis in this respect. The second pillar is policy making. The output from the analysis pillar should guide policy making, of course. For example, central banks can supervise financial institutions about how they should manage, assess, and disclose climate-related risks. Currently, it is difficult to say that banks satisfactorily have such capacities. The euro area figures suggest that only 1/5 of banks have a systematic, well, somewhat systematic way of assessing climate risks. And almost all those banks report substantial material impact of climate change on their risk profiles. To guide policymaking, an effective policy framework should have access to, first, well-calculated carbon price that reflects the true social cost. Second, consistent, transparent, and accountable data on climate disclosures. And third, well-developed and well-regulated capital markets to facilitate green bond issuance and the regulatory framework associated with that. So this framework should be supported by a formal international network to disseminate the existing knowledge and know-how and to facilitate international cooperation, which is a very critical element for success. As far as I know already, there exists a network of central banks established for this purpose in 2017 and hosted by Banque de France, the network for greening the financial system. Another one is I think 83 or so central banks are members of this network. Another one is the Climate Training Alliance, which aims to enhance the training resources that are available to national financial authorities. BIS, I think, directly supports the alliance. And the third pillar is taking action, of course. This is the most critical and also controversial pillar. Building on the accumulated knowledge and analysis, central banks should act within their mandates to mitigate climate risks. One straightforward avenue is purchasing assets linked to green transition and environmental sustainability. I believe that there is now a wide consensus on the feasibility of this step. Well, I also buy your question on the, what happens after QE ends. Well, of course, and this is not a now feasible option for the developing countries' central banks. That's another story. Some central banks already agree on implementing policies along this direction. An important aspect here is the framework for disclosure requirements for private sector assets to assess the eligibility criteria. Several central banks go beyond the monetary policy operations and get involved in supervisory actions regarding monitoring banks' capacity in embedding climate risks into their organizations and make this as a key part of their supervisory toolkit. I would like to highlight that central banks across the world are quite heterogeneous in their institutional and organizational structures, their primary goals and mandates, and their positioning within the country-specific institutional spectrum. So it is hard to raise a one-size-fits-all type of prescription. Challenges posed by COVID-19 pandemic add substantial complexity to the existing problems. But overall, central banks should continuously advance their capacities to measure, understand the risks, support stakeholders, and enhance policy coordination, and then take action. Finally, for the Turkish Central Bank, climate considerations started to appear in major policy documents, such as the inflation report quarterly published, and also the Monetary Policy Committee decision documents. Well, although promising, these are still baby steps and much more effort is needed to actually help mitigating climate risks in Turkey. One main advantage for the Central Bank of Turkey is that they have access to quite high quality and large and accurate database for firms and even establishment level balance sheets and transactions, not only credit transactions, but also transactions for goods and services. I mean, the trade data. Granular 12-digit trade data, which provides a sound basis for developing effective monitoring tools. Well, on the issue of, without having equipped with any QE option, what can developing countries do to support this transition? Well, one tool that Central Bank of Turkey uses to support exporters, let's say, they provide an export credit in Turkish lira, and in turn, they get their export receipts. The purpose is just to accumulate FX reserves. Well, one option is to transform this tool into a credit channel, to provide some, financing cost advantages to firms and other institutions implementing this green transition investments. I think there is some discussion, some policy debate in Turkey along these lines, playing with this export credit tool and transform it into a green transition tool. But I mean, there is no concrete tool developed yet. So this is just a perspective from Turkey. And this is the end of my talk. Thank you very much for listening.
Thank you. Can I ask something? I mean, I was struck. I want to give you an anecdote. I was struck by the word central bank, right? So the central bank is central. It oversees the economy, and obviously trying to model the macro and trying to think about policy. What it interacts with is it interacts with local. So let me give you a story. When I was on the MPC, I was asked to go and visit a place on the Isle of Wight, which made made the blades, right? And they told me two things, and you'll see the second bit, how it interacts. The first bit is that they only need 2 windmills, but people don't like the look of 2, so they have to do 3, right? So they're £1 million a piece. But here's the question I'm going to ask. Their view was the major cost that they had was because of NIMBY, right? So they said for every single time we're going to go to a local place and we want to put up a windmill, we have to hire lawyers. It's at least half the cost. Every little town we go to, the lawyers come in and it costs us a lot. What we'll say is we bring the windmill and you'll build the structure. But what they spent a lot of time and eventually went out of business for this reason, if you're going to have a central bank, you're probably going to have central regulation about how you implement this climate change. Their view was if you could get the UK government to say, okay, here are the rules for a windmill, rock and roll, off we go, that could operate. But they basically couldn't operate because there were so many local rules. And of course, that would make it hard for you to, I mean, the things you've said, you know, we want to macro model it and think of it. Essentially, a central bank, if this is going to work and your models are going to work, you have to somehow or other overcome the NIMBY problem and have something like centralized regulation. Question, but the business went out of business because of local regulations, which raised the cost so much that they couldn't basically get windmills put in place. But if like the federal government or the government of Turkey had said, here are the rules, right? You see where I'm going with this? Your models are better if every town is doing, your models are in a mess. What do you think? Central bank against how you implement climate stuff?
Locally, you mean?
Yeah, right. And when you have it implemented locally, the central bank, you know, is in problems to try and actually work out stuff.
Yeah. Well, the big question is whether central bank is a bank. I mean, I don't want to get.
I agree, of course. Yeah. You see where I'm going. This word central is central here.
Well, those big models, they are, you know better than I do. I mean, just to understand what's going on in terms of like the main transmission mechanism. So they're not built to understand what happens locally or in certain sectors or in any micro or sector level economic dynamics. So now, but I think there is some progress at central banks in terms of understanding what's happening locally and at sector level and even some subsector level. Even within the Bank of England, there is an initiative called like agency reports. Bank of England agents reports. And also there is this similar initiative in the US, this Beige Book, right? So Absolutely. Now, central banks now, they try to better understand what's going on locally, regionally, at sector level, even at firm level, right? So because, you know, think of a large firm and what happens with that large firm can provide some guidance, what happens at micro level. So now this is at the Central Bank of Turkey, there is a project similar to this too. And this really extends rapidly. And now almost, you know, all major central banks have a similar initiative. So on the one side, there is this macro models, and on the other side, there is this, you know, survey-based,
but the actual implementation, implementation of what you've talked about is very much going to be impacted by local, right? And that's going to make it hard because people have, you know, there are NIMBY rules. I don't want a windmill outside my house, that stuff.
Yeah. I mean, that's quite micro. Maybe central banks can develop some new cooperations with some, you know, development agencies, national, you know, some local stuff, which I believe is now happening much more frequently than it was in the past. So I think that's an option, and that can be used to, you know, facilitate this new financing of green transition options. So that's the answer that I have.
Excellent. Actually, one quick thing. So yeah, the Bank of England had agents and this Beige Book exists in the United States. I gave a talk last week to the Central Bank of Australia, and actually they have it too. And the reason they have it is the person who ran the Bank of England agents in Britain when I was there actually went to the Bank of Australia and is actually implementing it there. So there's actually mobility between the central bank on these agency things. So this was interesting. So I met the person. She was the person at the Bank of Australia last week.
Great exchange of know-how. Yeah, great.
Exchange of know-how. Thank you so much. We're on time. That was absolutely excellent. Thank you very much. So now we move to, and we're running on time, which is great. We'll have some time at the end. I would encourage people, if you want to put a question in the Q&A, that's fine. And we'll hold it till the end. But there aren't any questions so far. But I've always got lots. So anyway, so super. Thank you so much, everyone, for staying on time. We now move to Papuna Lezova, if I have said it correctly, Vice President of the National Bank of Georgia, and former advisor to the World Bank. So obviously very interesting background. And again, I would ask, what can the world learn? I mean, this is really interesting stuff. People have been through different experiences. What is the world to learn from your experience? So Papuna, hopefully you're here and we can go to you.
Yes, I'm here.
Oh yeah, I saw you before. I know you're here.
Yes. Great.
So obviously I think, as I say, a question is, what does the Bank of England know? We sat and listened this morning to the Bank of England talking. What should they learn from this? Because I think broadly everybody else's experience in the rest of the world is actually more advanced and more developed than the developed world. So the Bank of England and the Fed, they need to learn from all these experiences. So that's what I was hoping to hear, if that's okay.
Yes, of course. Thank you, Professor, and thanks to the previous panelists who set the stage for me. They touched a lot of topics and made my job easier. So thanks for that. Let me share the presentation. I hope you can. Can you see the presentation?
Yes, I can see it. I hope everybody else can, but I can see it fine. Thank you.
Okay, great. So what I will cover today is the perspective of Georgia on sustainable finance. So we believe in order to support sustainable development and ensure financial stability, it is essential to incorporate environmental, social, and sustainability standards in the central bank's policies. But ironically, recognition of this fact is the key. So not everybody does so, but that's where we start. I'm happy National Bank of Georgia has recognized this fact. At National Bank of Georgia, we've been working on the sustainable finance framework since 2017, and this framework implies consideration of social, environmental, and governance issues by the financial sector and capital market participants on managing risks associated to them. In 2019, we launched the roadmap for sustainable finance in Georgia, and it's our main policy document. The roadmap covers 3 years from the period of 2019 to 2022 with corresponding goals, milestones, and then the exact timeline. The ultimate goal of this roadmap is to provide a credible, predictable, and stable regulatory framework and prepare the market for transitioning to sustainable finance. The actions listed on the roadmap are grouped under 4 main pillars. Pillar 1 is to support capacity building and increase awareness. Pillar 2 aims to guide financial flows towards the sustainable projects. Pillar 3 ensures proper incorporation of ESG into risk management and decision-making of the financial institutions. And finally, Pillar 4 supports transparency and market discipline. So most of the actions that we had under these 4 pillars are already undertaken. And you can see this is a little bit heavy slide. You don't have to read every word of it, but this just showcases the amount of work we have undertook since 2017 to address sustainable finance issues. In 2021, now commercial banks for the first time have used ESG forms provided by the National Bank of Georgia to disclose corresponding information. And this year, amendments have been made to the corporate governance code as well for the commercial banks to integrate the ESG considerations in more comprehensive way. And in particular, the amendments define the responsibility of the supervisory boards of the banks for integrating ESG issues into their bank strategy and risk management framework and require their effective implementation. The changes also specify the ESG form as a required template for disclosure of ESG information and refer to the National Bank of Georgia's ESG reporting disclosure principles. Furthermore, the ESG reporting form was added to the Pillar 3 annual reporting, which is the main disclosure form for the banks. And currently, all banks in Georgia are disclosing ESG-related data under their Pillar 3 disclosure forms on an annual basis. This kind of disclosure ensures the comparability between different institutions and consistency of the data. But the information from ESG reporting forms indicates that majority of commercial banks actually do not have a good definition or classification system for green loans, and thus do not have data on it. And just to give you an example, on the next slide, so you can see that about 400 million of loans have been disbursed in Georgia under the green standards, but actually only 6 out of 14 commercial banks provide data on green loans. Among these 6 banks, most do not have formal definition or classification system for green loans and only include energy efficiency and renewable energy projects under these loans. Now, this indicates the need for a common classification system and highlights the importance of having a green taxonomy, which is one of our priorities in Georgia. Now, to address these challenges, MBG, in cooperation with various stakeholders, is working on developing sustainable finance taxonomy for Georgia. The taxonomy aims to address the classification problems, the definition problems in the market, both for social issues as well as ESG related to green climate issues. The taxonomy will include the details about both of these directions. The green taxonomy provides a list of activities that aim to achieve environmental objectives and contribute to development of green economy, while social taxonomy proposes a list of categories focused on achieving social objective for the specified target population. And National Bank of Georgia will support financial institutions in taxonomy adoption through consultations, through trainings, and technical assistances. And once we adopt this sustainable finance taxonomy and banks start to apply it under their reporting, we hope that the data will become more accurate and consistent. Now, let me also summarize some of the next steps that are in our pipeline. First, the MBG, in collaboration with IFC and World Bank, will be developing the ESG risk management guidelines next year. The ESG risk management guidance will be consistent with the best international practice, but also incorporate some of the local context. And as we continue the implementation of action plans set out in the roadmap, it further acknowledges the importance and significance of addressing climate risk and ensuring macro stability. We have also joined throughout this process the NGFS network in 2020 and outlined the responsibilities for the central bank. Under this partnership, we have outlined the commitments that the National Bank will be taking. Let me go back to the slides. And this goes beyond the roadmap that we have implemented in 2017, and we're taking more specific commitments that you can see on the slide. So primarily, MBG commits to build awareness of the climate-related risks among the financial institutions in Georgia. Second, MBG commits to perform climate scenarios and climate-related stress tests, which will be primarily based on NGFS scenarios. And this process is currently ongoing. The MBG will also continue to work jointly with other financial institutions and stakeholders to better understand climate-related risks for Georgian financial sector and the economy overall. And finally, MBG commits to lead Georgian sector by example by making our own operations green and support smooth transition. So as you can see, the MBG has made significant progress towards sustainable finance in the last few years, but the work does not stop here, of course. We have to continue, and even beyond our current roadmap of 2022, there is a lot that has to be done. Thank you very much for listening, and now I'm open for any questions.
Thank you. I had a thought as you were talking. Obviously, the question is how big is the problem? I wonder if you've evaluated that and how much progress you've made to it. But I had a couple of thoughts. The one obviously relates to what we were talking a minute ago about how much local opposition is there. I mean, we all talk in here and say climate change is great, but if you certainly in the United States, there's local opposition to it. So I was just going to try and get you to talk about, the way you said it was like a process of osmosis, but you might think that the central bank, clearly you obviously thought about this. I just wonder what your thoughts are about carrots and sticks. So on the one hand, that you sit there and you say, this is our goal, but the question is, well, how do you get people to conform to it? How do you get the banks to do this? So the first one is, what incentives can you give? And obviously it's in the early stages, but at some point, surely you have to think, we have to use sticks as well, right? We'd like you to do this. We'd like you to step along this path. We have this bold set of goals that you've talked about. But ultimately, does the central bank have any power other than just hoping it happens? It can provide incentives, but in the end, do you think it actually has the potential or the ability to penalize those who don't? You see where I'm going, right? I just think those are interesting thoughts. And the numbers you've got, 400 million is not that much money, but obviously, how bold can the central bank be? And how much is it dependent upon what the central government does to support it? But you can see those are, I think, interesting questions.
Yes, thanks, Dan. This is a very good question, and probably the question every central bank is trying to answer.
Well, I'd like to hear how you guys have dealt with it, of course.
Yes, of course. So primarily we have to solve different problems in Georgia, as I was telling during the presentation. We don't even have accurate data to answer what are the risks we're talking about. We don't have good enough understanding among financial sector players. So we have to build awareness, work on the disclosures, raise the capacity of the financial sector players. Then if we come to the question whether central bank can impose certain limits on restrictions on non-green lending, well, we can, but should we? So that's probably...
Yeah, exactly. A, can you? And B, should you? That was exactly the point I was trying to get to.
Yes, exactly. And so currently the hypothesis, so we will test throughout our exercise, to collect data and do stress scenarios, is exactly that. So we have the hypothesis that climate is impacting financial sector. It is impacting price stability, and these are the key objectives and goals of the central bank. So if we prove that climate is really impacting financial sector and the price stability, then obviously we can move forward. It's probably a little easier to create this link between financial sector stability and climate risks. It's more challenging to create the link to our macro policy and price stability. And this is a relatively new trend that we're seeing, and there's not a lot of work and research done in this field, but that's certainly something that we are looking at, including on the macro side as well.
Let me just follow that. I mean, Professor Shirai talked a bit about the difficulty that central banks have in the sense that, in a sense, they draw neutrality, right? Isn't a danger? And I'll just go to a conversation I had with Ben Bernanke. Ben Bernanke told me in his office, he said, in the United States, there are 3 things that the central bank can buy. They all have to be federally insured. The first are treasuries. The second are mortgage-backed securities. But the third are short-term municipal bonds. So the question is, why have they never bought it? Right? Why have you never bought municipal bonds? And the answer is because of Professor Shirai's very good point about neutrality. The danger is, and this is a follow-up question for others too, the danger is if you go in here and you start to do carrots and you start to tell people things and you say, aha, we like those ones, the Fed is very worried that how can it go into Detroit and buy a Detroit bond rather than an Atlanta bond? So is the possibility, you see where I'm going with this, and they've never done it for exactly this reason. Is there a danger in what you've talked about that perhaps you break the neutrality thing, that you end up, well, the danger is you end up picking winners, but the difficulty might be that you end up picking losers. And that has a really big impact on you see the thought, but there's a reason why the Fed has not bought munis. The question is this inevitably going to be a problem? Because you're going to sit there and go, oh my God, which ones do we buy?
Yes, no, I agree. It's definitely challenging to find the silver lining between these two. But you know, as we see, the trend is as time goes by, we have more and more policymakers who are getting worried about you know, ESG and the climate issues, and I wouldn't rule out that down the road we will have a majority that you know, and that will outweigh the market neutrality.
But it'll be some kind of general thing, like rather than picking a particular bank or a particular project, it'll be something broader than that, so you can maintain your neutrality, right?
Yes, but this does not have to. It should not, and it will not go beyond the central bank's main mandate of price stability and financial stability. There has to be a clear link.
Absolutely. Super. Thank you so much. This is great. We're on time too. It was really interesting. I'm learning a lot already. Okay, so now we're moving on. Again, if people want to answer questions, they can please do that. We're on time. So now we're moving on to Oyen Sandasuren, Director of the Division of External Affairs at the Green Climate Fund, which I don't know about, so I would like to learn about. Former chairperson of the Global Water Partnership, first president of the United Nations Environment Assembly of UNEP, and is on the advisory board of a number of international organizations, 5-time member of Parliament of Mongolia, and served as Vice Speaker of the Parliament, Minister of Foreign Affairs, Minister of Environment, Green Development. Oh my goodness, so much. So please, hopefully, they're here. Oyen's here. Yes,
I'm here, David.
Oh, there you are. Super.
Yes.
Super. It's such a long list of things. I'm
sorry. I'm sorry, David.
No, I'm in awe. I'm learning from everybody.
The Environment Assembly means environment ministers gathering twice a year.
Yes.
So So greetings and very interesting discussions. And I actually also listened to the previous sessions as well earlier on. So thank you very much for inviting. So the question I was asked to address, and of course there are a lot of questions, but at least the one which I was trying to focus on is that how can multilateral organizations, but also international finance institutions, development institutions, can create ways to reduce the cost of capital for sustainable and climate sort of resilient ways, right? So I represent Green Climate Fund. It was conceived, some of you may know, it was conceived 10 years ago during the Cancun COP, but it became operational more or less only 5-6 years ago. So relatively new multilateral climate finance institution, and it's a key element of the Paris Agreement, and we're mandated to support developing countries. Now we work with more than 140 countries, and the idea is to, through the climate finance, through investment, raise the climate ambitions and investments in developing countries, right? So to help them to leapfrog to low emissions, climate resilient development pathways. So although it's been only 5-6 years, and I think since our first funding proposal, or the first funding proposals that was approved by our board was in 2015. So it's been only, I suppose, we're getting into 6 years, but our portfolio has grown since into $10 billion portfolio. With co-financing, the total portfolio is about 37 billion. And when I say co-financing, our business model is such that we work with and through our partners, and they're called accredited entities. And we have just over 100 accredited entities, and there are international partners like World Bank, ADB, and EBRD type of partners, but also we have national partners as well. They can be local commercial banks, local development banks. Some of them are actually civil society organizations, public sector organizations, also of United Nations agencies, etc. But we also work with private sector as well, including with private equity funds. So about 35% of our funding thus far actually went to private sector. The remaining went to public sector. We have to fund also adaptation, not only mitigation. So we try to keep this balance, and we're also mandated to keep the balance between mitigation and adaptation projects. And we're also asked, of course, by our board more and more to work and leverage more private sector capital, catalyze private sector investment, but also work with what we call direct access entities. So make this paradigm shift with national institutions, including local commercial banks, for example, right? Because that's how the key sort of paradigm shift and leapfrogging hopefully will happen, not just working through international organizations. So maybe the question on, and then I think it was covered a little bit before as well. Professor Shirai was saying, of course, for developing countries, it's with the COVID, right? The trillions were, released in huge stimulus packages. Of course, for developing countries, not possible. But at the same time, of course, the key thing is how do we get the recovery right? Build back better. And that's when I agree also with Leslie that development finance institutions should be playing a really key role. And let me just explain to you with our approach at GCF how we try to do that. And I don't know whether I can just run just a couple of slides. I always have a problem when I try to run the slide.
Yeah, there you are. That's it.
Is it? Okay. So this is a range of financial instruments that we actually use. So let me just, maybe I'll just start with.
You run the slideshow.
Right. Is it? Okay. So what we see, and again, now working with more than 140 countries, we have this huge pipeline of projects, right? And the thinking in the developing countries of what type of investments they think, both in mitigation and adaptation, will be most helpful, or sort of not only the priority, but hopefully the key places to intervene in order to sort of make this major leapfrogging or changes to climate ambition. So, and then when we see that we see that the key important thing is not just more finance, and of course, we've been hearing in the last couple of days in Glasgow as well, especially with the finance day, 100 billion, and then more finance is needed, especially for development, which is absolutely true. But at the same time, of course, we understand, and most of us as well, that it's not just the more finance, but it's de-risking the investment, as Leslie was saying. It's not only the risk investment, but also innovation in policy and regulatory. Innovation, and then it's not only innovation, it's de-risking also policy and regulatory if needed, when needed. Also innovation in institutions, capacity building, of course, support with project preparation for things. It's not just innovation in technology, but also financial innovations as well. So when I say financial innovations, and maybe rather than financial innovation, it's just sort of a toolbox of different financial instruments that are very useful to use. And of course, GCF, we're lucky here because we're relatively not only partner agnostic, partnership agnostic, but also financial instrument agnostic. So MDBs, there are certain sort of course, MDBs are changing, but usually with development institutions that they have different sort of limits, but GCF was set up to be as flexible as possible and take as much risks as possible, as long as we come up with some bespoke solutions and help to move a project from business as usual to green, or a project that's probably very difficult to move from a place. And if we de-risk them, then, whether it's through very concessional loans grants into, not only adaptation, but as I said, in capacity building and institutions, and maybe creating good regulatory environments. More recently, of course, guarantees and equities are very, very important, especially when we want to work with private sector through the blended finance. And maybe I'll just use a few examples of what we do. I don't know whether if I can just run it. Okay, so for example, on transformational planning, especially with the recent green recovery and creating the enabling environment. For example, we've been supporting St. Lucia to design, integrate climate resilient recovery measures into their NDCs, for example, right? And make this NDCs into detailed investment plans. How do we use that also to, explore financial innovations like resilient bonds and climate debt swaps to supplement public resources and to finance the investment without raising the debt burden. The second thing is accelerating climate innovation, and maybe an example of, I mentioned we work with some equity funds, but US Impact Investment Fund, for example, Acumen, and we've been providing, again, during the COVID year, last year, providing a risk capital to small and medium-sized enterprises in Eastern Africa to develop off-grid solar and climate-resilient agriculture solutions. And although Acumen has been investing because of COVID, there was a risk of solvency risks, and so we've injected some risk capital to prevent that, for example. Another example will be us supporting a development of the first Caribbean regional green bond exchange in Jamaica. It's very difficult to raise funding at the subnational level, as we all know. So again, with another equity firm, Pegasus Capital, we invested, for example, 150 million in GCF's equity to mobilize another 650 million in institutional finance for climate mitigation and adaptation projects at the subnational level. So if we come with first loss equity or first anchor investment, that sort of moves, private capital, and that catalyzes, hopefully, and shifts, things from the ground. Again, coming up with some new asset classes. And for example, we're working with CCRI, it's a Coalition of Climate Resilient Infrastructure, and then Oxford University, trying to come up with the methodology. How do we factor climate risks and opportunities into financial decision when planning climate resilient infrastructure, and then making them potentially into new class of asset class, and we're trying to test it in Jamaica as well. So I'll stop here, David. But basically, our experience is that it's no longer just vanilla type of project, just investing in renewable energy. But how do we make sure that with $1 of scarce public money, how do we move or catalyze the next $10? Hopefully, not only public investment, but of course, it's not just this. No, for SIDS, vulnerable countries, if it's adaptation, then of course, it has to be grants, right?
Right.
But in order to shift the whole financial system, all this innovation is needed. So I'll stop here. Thank you.
Thank you. That was really interesting. Where do central banks today stand in terms of aligning with net zero target from Changhua? Where do central banks stand today in terms of aligning with the net zero target is the question. I don't know the answer to that, but maybe someone else does. Help.
Isn't there the central
let's say Shirai.
Also, Shirai, you probably will know much better, but there is this central banks alliance.
Yeah. So Bank of England is the only central bank which has its own emission target from like printing notes. And also they check their portfolio balances, and then they say their temperature is at this moment like 3-degree, a corporate bond. So they try to make it greener. Only Bank of England is doing that.
Yeah, the only thing it's really interesting you said that. I mean, you know, I was always on the MPC. The only issue with it is it's not clear to me what it actually means. Right? What is the so if you say I impose this, we say things like, it used to say stuff like, and be in line with the government's goals about well-being, happiness, and, you know, stuff. So you say, we'd like you to be aware of that. I don't really know actually what it means, or go with back. Unclear to me how it would actually change behavior. Let's say, look back 10 years. If that goal had been placed 10 years ago, how would it fundamentally have changed behavior? And it's not clear to me that it's anything other than empty words. But
one way, David, that it could have meaning. One way that it could have meaning. If there are mandatory stress testing, climate risk stress testing integrated in the financial models of central banks. So the Bank of International Settlements published a piece called Green Swan, which is a series of which they published about, I think, the early part of this year, where they effectively argue for the integration of climate risk within, and they in fact argue for regular stress testing for financial stability. So in other words, when you look at macroprudential regulation in a particular country, you introduce climate risk in there. So essentially,
and you think that's a substantive, that substantively could change behavior?
Exactly. I believe that it is emerging. It's not quite there yet, but the BIS is certainly thinking about it, and they are kind of the overarching body of central bank.
That's interesting. I mean, in a way, it goes back to my initial thing, and we're nearly done. In a way, that fulfills Smith's theory of moral sentiment, which is we care about others. And I'm going to finish with the last bit because we're sitting in Glasgow. I thank you all very much indeed. I think what you all talked about is actually that. These are ways of improving the wealth of nations. Seems to me a good place to end on. We've got a couple of minutes to go to Anton, but thank you all very much indeed. It was excellent. I learned a lot, indeed. Thank you, everybody. And we're a couple of minutes early, but please, I think can we stay on here, Claire, and hear Anton? Is that
of course you can.
Please stay.
Love it.
So Anton's a great fellow.
To hear Anton.
He's president of the University of Glasgow, and he's an economist, and he's just a super guy, and he cares about what you've talked about. So if it's all right, we'll sit here and let Anton come. There he is.
Hey,
the man.
Hi, how are you? Are you well?
The man.
Welcome all.
I have a question for you. Somebody asked me. And I said, you're the guy who can answer it. How did Glasgow get COP26?
It's not a very romantic story. Basically, there was a competition across. It was Europe's turn. There was a competition. Italy and the UK actually went together to bid for COP26 and won the bid for hosting it. And effectively, they decided how to split the events. They decided the main COP26 should be in the UK, and it was chosen, and Glasgow was chosen as the venue by the UK government. With, as you know, the Youth COP was in Milan, and the G20, of course, happened in Rome, just literally days before, and that was all again coordinated to make sure that Italy would get its share of this. So I'm afraid it's like the Olympics. It's
but the great thing is, I told them you'd know.
Well, there you are. So it's like, well, I haven't been able to tell you what the telling elements of the bid were, but anyway. But thank you all for joining us today. It's a real pleasure to see so many distinguished economists here. So would you like, just checking if colleagues want me to start now, or whether there's anything else before I kick off with my concluding comments? Am I okay to go?
I think you're good on our end, Anton. Thank you very much.
Excellent. Well, look, good afternoon. It's a real pleasure to be with you, and apologies I haven't been able to be with you all day, because it's been an excellent and truly insightful conference from what I could gather, just seeing the program, but also occasionally dipping into it. And I really wanted to thank everyone at the Adam Smith Business School for organizing today's event. And on behalf of the University of Glasgow, just to express my sincere thanks to all of our esteemed speakers who've been so generous with their time, their wisdom, and in sharing their experiences. And we've heard from some world-leading economists, Nobel laureates, Nobel Peace Prize winners from our own university in the center of Glasgow, all the way to Central Asia. We've heard insights from some of the world's largest companies and from experts from a number of academic institutions, from Siena and Firenze to Oxford and New York, Tokyo and Turkey. So, and we've heard too from global organizations who've shared their perspective on achieving net zero, including the International Energy Agency, the Russian Academy of Sciences, the New Development Bank, the IPCC, the World Economic Forum, the Bank of Ghana, and the Energy and Resources Institute in New Delhi. And I hope you all agree that we've been treated to an absolutely host of invaluable speeches and debates. But above all, I think what we've seen today, as in many events around COP, a real global community of leaders and opinion formers come together, each with the intention to really help from our disciplinary perspective today, tackle the greatest challenge of our time, which is climate change. This week at COP26, we've heard many, many speeches. One speech that in particular resonated most with me was that of Sir David Attenborough, actually, who said that the fate of future generations must give delegates the impetus, as he said, to rewrite our story. And the same too, I think, can be said for all of us in our wider society. Now, of course, yesterday, as you're all aware, was Finance Day for COP, and one of the striking features of the conference so far has been the high profile of industry and finance in the discussions, more than at previous COPs. And governments alone cannot achieve the transition to net zero. We need to mobilize and leverage that financial support from the private sector, both directly and brokered via multilateral institutions. And we all have a duty, industry, academia, government included, to step up and tackle the climate emergency, to really rewrite the status quo and change our habits and our practices have been to just for the sake of the planet. Our transition to net zero carbon emissions will be the most radical economic transformation we've ever made in peacetime. And we heard today too of the importance of reshaping finance to adapt this transition and really the importance of ensuring that we consider the need for a green recovery in conjunction with a green transition. There was a session yesterday as well around economics, in a session we held with the Economic Observatory. And the founding director of EFTEC, which is a consultancy in the environmental economic space, Ece Uzdemirolu, noted that climate risk used to mean how much will a carbon tax cost me? But now it actually means a vast threat to human life, to property and entire economies. And I think people now really do recognize, everybody recognizes how extreme the risks are that we're talking about if we don't act now. And one thing that did come out very clearly from COP26 is that the next decade is the crucial decade if we are to avoid destroying our planet. So, this is not a question of a path between now and the end of the 21st century. It is the next decade that matters. And of course, the Industrial Revolution was driven by the active pursuit of profit. But this time we have to be driven by the emergency facing our planet, coupled with the need to ensure, I think, a fair and just recovery of our world economies from the pandemic. And we're driven by a need to change course and rapidly. And COP26 is happening in a city, and you've heard a bit about Glasgow in the last session, that's always embraced change. Glasgow thrived from industrialization, but it was one of the first cities in the world to declare a climate emergency. And so did our university. We were the first institution in Scotland, certainly, to declare a climate emergency. And we have set a target of 2030 for achieving net zero in our own emissions. So as I see it, I think there's a lot that we can learn from one another. We must share this knowledge across borders and continue with the global outlook that we've heard today. One such lesson to learn from the perspective of universities is the importance of the skills agenda in achieving net zero. Skills are an absolutely key element of sustainable competitiveness, of productivity and resilience. Businesses need workers with the skills required to master the green and digital transitions, and people need to be able to get the right education and training to thrive in life. And here we have a real opportunity to align skills provision with the needs of our societies. This could see, for example, a greater focus on upskilling and reskilling of workers in the energy sector into greener and renewable methods, or retraining our existing workforces to be able to better tackle the challenges of achieving net zero. And for example, in the University of Glasgow, we've introduced changes to our curriculum to ensure that all students are exposed to carbon literacy and climate change so that they leave knowing the vital role that they can play in their careers. A green transition will also place much more of an emphasis on digital innovation and green technologies, and there will be a need for all of us to step up in this regard and make the most of the fantastic research happening at our universities. And this too will support an innovation-led recovery from the COVID-19 pandemic. If I, again, focus on Glasgow for a moment, we're at the cutting edge of key and emerging technologies that will be crucial in supporting the transition to net zero, but will also be crucial in driving productivity and allowing Scotland and the UK to recover and compete internationally. And particularly in our area, these include technologies like quantum technologies, like life sciences, like 5G and the Internet of Things, all that feed into important issues such as domestic heating and the transport challenge. And indeed, our economic footprint as a university is far-reaching. And just last week, we released a report by London Economics on our economic impact, which estimated that our contribution to the UK economy stands at 4.4 billion, and 42% of that is as a result of our research excellence. Now, to reach our net zero targets and accelerate a reduction in carbon emissions, we will also need to see focused government leadership across the globe. And we heard some of that in the last session. This was discussed in depth, as I said, in the session that my good friend and colleague Danny Blanchflower chaired. And in fact, I think many of the arguments made during yesterday's Finance Day at COP centered around how to get private finance aligned with public sector funding to boost global investment in climate and nature positive technology, innovation and infrastructure projects. We really do need a shift from short-term thinking in finance to sustained commitments and long-term investment. And the UK Climate Change Committee recently articulated as well in asking for a net zero test and a net zero strategy to ensure that all government policy, including planning decisions, is compatible with climate targets. And in fact, it was the chief executive of the UK's CCCs, Chris Stark, who was an alumnus of Glasgow, actually, who recently underlined the type of investment needed to reach net zero in the UK. He argues that the investment needed annually at the UK level over the next 30 years amounts to only, and it's a large number, but it's about 50 billion of extra investment each year after 2030. But when you think that this investment doesn't need to come from government alone, but with the government in the lead, and it comes from the private sector, it is perfectly doable. And it was one of the positive messages that came from his talk recently in Glasgow. I think it's been restated this week by others before me that many of our global economies at present are still too heavily reliant on fossil fuels. And again, what Chris Stark of UK CCC emphasized is that by investing in key green and clean technologies, we could actually see a saving to the economy by not spending on fossil fuels and redirecting our attention to technologies that can drive cheaper renewable energy production. Now that the prices of some of these renewable energies have fallen considerably and actually outcompete some fossil fuels, and it can make a real difference now. It's about the technology of now trying to translate that not only into electricity from electricity generation and tilting that towards the other big challenges, which are domestic heating and transport. And over time, we could actually offset the cost of the investments overall through those savings that we're making in not using fossil fuels. Now, of course, challenges remain. Many of our tax revenues, which fund public services, depend heavily on taxing fossil fuel consumption and transport and other areas of economic activity. And there will, of course, also be distributional effects here. There'll be groups which will benefit and others that will suffer economically as a result of the transition to net zero. And those distributional effects, as economists, are really important. We need to address them in the way the governments tax and spend. And indeed, talking of redistribution at the global level, we've heard again this week of the need for wealthier nations to recommit to the $100 billion per year figure agreed at Copenhagen and later at the Paris Agreement to nations impacted the most from climate change and who have historically benefited the least from the financial gains made through fossil fuels. And so far, many developed nations have largely shirked this responsibility. But again, Glasgow provides us with an opportunity for our governments to show their willingness to collaborate across borders and ensure nobody's left behind in the race to net zero. And again, without sounding like a broken record, I think Scotland is demonstrating this willingness to lead from the front. Yesterday, UN Secretary General Antonio Guterres spoke of Scotland being one of the first international actors that has determined money for loss and damage. And this is a really important point for developing countries. I think in moving forward, we must really use this crisis facing us as a catalyst for change. We can really use COP26 as an inflection point in deciding the types of nations and organizations that we want to be. We have seen through history the challenges created by crises, but we've also seen the extraordinary changes that come about as a result of crisis. Just take the pandemic as an example. You know, my fellow economist from Cambridge University, Professor Diane Coyle, recently, as part of the Productivity Institute that Glasgow University is part of, published a study on productivity performance of the National Health Service in England during the pandemic as an in-depth case study of what happened on the ground. And it showed that the sector made drastic improvements in terms of knowledge transfer, coordination, and technical innovation that would have been taken years to develop otherwise. And that's by getting buy-in from their whole workforce. So it's about involving our people in those organizational changes. And following the 2008 crisis, you know, central banks, regulators, policymakers were forced to take extraordinary measures. But as a result, the banking sector is better capitalized today than it was before the crisis. And again, going further back, we can look at the Wall Street crash and the Great Depression, which saw Franklin D. Roosevelt's New Deal enacted. Again, unheard of at the time, and a new era of US economic recovery and eventually post-war expansion. And today, with the emergency, I think, facing our planet and the economic impact that we faced during the pandemic, we have a real opportunity for change. And the will is there, but it will require all of us to step up and embrace the net zero global economy. We've heard lots today about a willingness to collaborate and to lead from the front, and it's these bold and ambitious commitments that we need going forward. So on that note, I really hope that today has been a fruitful and enjoyable event for you all. And for those who will be in Glasgow, who are in Glasgow for the remainder of COP26, I hope you'll enjoy our city. I hope you'll all see some real tangible commitments made in the coming days. And as we wrap up today's proceedings, can I take this opportunity again to thank all of my colleagues at the University of Glasgow for the time and effort they've put into organising this fantastic conferences. To everyone in the Adam Smith Business School, the Reinventing Bretton Woods Committee, and particularly to Professor John Tsoukalis, Claire Taylor, and Professor Sarah Carter. And once again, thank you all to our wonderful speakers and session chairs, and hope to see you soon in Glasgow again. Thank you.